to represent the Democratic Party. But Jonathan, whether it's this Wall Street Journal poll or the AP poll, this is becoming an issue for the administration because it's not just independents, which they're worried about, it's within their own party. But still, Democrats will maintain that regardless, they still will vote for Biden if they're the ones, if he's the one that the Democratic Party in the end, and it's likely to put forward as the sole nominee for the primaries. So I expect more of this. It's a big issue on the Congress as well. It's not going away anytime soon. Anne-Marie, thank you. AMH on the latest down in Washington, D.C. Coming up, the latest on the pricing around the ARM IPO. We'll bring you some numbers, and we'll talk credit with Winnie Caesar of Credit Sites. Live from New York City. Good morning. It's a big issue on the Congress as well. It's not going away anytime soon. Anne-Marie, thank you. AMH on the latest down in Washington, D.C. Coming up, the latest on...
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1.
Right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Live from New York City this morning. Good morning. Your equity market shaping up as follows on the S&P 500. Negative 0.2% on the S&P. No drama here on the Nasdaq, down about 0.4. Pulling back on the Russell, the small caps, much more negative. We're down here by 0.8% following a month of losses on the S&P, but pretty tame stuff that we've discussed, Tom, this morning so far. Losses on the S&P for the month of August of 1.77% on the NASDAQ, just down 1.62.
I'm going to push against the drama. You mentioned it earlier, John. I think you're right. Euro threatening a 106. I think foreign exchange is talking to us within the quiet of a Tuesday as the business season starts.
Would you like me to skip the bond market and get straight to the euro?
No, I think the no drama in the bond market is there. Look at the real yield. I just got the print. The 10-year real yield is a 5 basis point jump to 1.97%. There's some drama going on out there away from this, a quiescent bond market.
We'll get away from the stock market. We'll turn to bonds briefly. 2-year, 10-year, 30-year. The drama of the last couple of weeks, 436 on a 10-year, back down to 422. Yields popping a little bit this morning by 4 basis points. The 2-year having a look at 5.1% in the last couple of weeks, and now back down to about 492. Yields up at the front end there by 4 basis points. And dollar strength, the story in foreign exchange. The euro against the dollar. Tom with one eye on that. The euro at the moment, 107.34. Negative by 0.6%. Going into the ECB on September 14th. That's a couple of Thursdays away, Tom.
Sterling 125.51, rounded down. Maybe it gets to a 124. That's a different price point.
Yeah. By definition,
yeah.
If price changes, it's a different price. Under surveillance this morning. Goldman Sachs cutting the chances of a US recession to 15% from 20. You're killing me. Chief economist Jan Hatzius, writing quote, "We still strongly disagree." You're so upset about Friday still. Let's get to Jan Hatzius. Let me start that quote again.
Please.
"We still strongly disagree with the notion that a growing drag from the long and variable lags of monetary policy will push the economy towards recession." Your second story, from Chinese developer Country Garden avoiding default, at least for now. The firm made good on 2 bonds within the grace period, but the debt crisis isn't over. Country Garden bonds are trading between 9 and 14 cents on the dollar, while the Chinese government looks to boost the property market by relaxing mortgage rules. TK, have they done enough? And is there more to come on the policy side?
And I'm glad you brought this up, John, because this is about the property market. It's about domestic affairs. It's about the balance sheet of cities, the SOEs, the state-owned enterprises, and the rest of it. I'm still seeing with the FT, with a great article this weekend, China growth of, to be kind, 4-ish to 5-ish. That's not like doom and gloom, but that's not what this is about. This is about their domestic balance sheet, which is a train wreck.
Well, you've got to compare it to where we thought we would be starting the year, Tom. We thought maybe closer to 6 on GDP, and certainly not a 4 handle. I want to finish on this story. SoftBank's ARM planning to raise as much as $4.87 billion in what would be the biggest IPO of the year. The lower than the range, Tom, lower than estimated $8 to $10 billion they were looking to raise, Tom. So 4.87, they were looking to raise 8 to 10. Lisa, just in terms of valuation, they were looking for something in the 60s, maybe close to 70. That IPO looking to raise maybe something closer to 50 billion plus. So we've cut this one big time, haven't we?
$64 billion was the valuation of ARM back with the Vision Fund earlier this year, and now we're looking at 50 to 54 billion based on the price range. So a couple questions here. SoftBank, they're retaining a bigger slice than they previously thought. Are they trying to minimize losses, basically, at some point? That's number one. And number two, does this speak to the appetite, given that it is going to be the biggest IPO on the NASDAQ, going back to Rivian? How much does this speak to something more general versus a specific story?
Broader market problem or a SoftBank valuation problem?
Exactly.
I've seen a lot of SoftBank valuation problems, haven't we?
That's been a perpetual theme, hasn't it?
Can't get away from it. This was meant to be a win, Tom, and over the last week, looking less of a win.
You know, you look at the eight paragraph summary here. ARM announces launch of IPO roadshow. Mizuho Securities USA is the title's hilarious. They're the roadshow manager or something. What are they going to do? They're going to do rubber chicken at the Hilton Hotel with 45 days baloney. They're going to call up 5 people and say, we have Apple as a minority interest. What price will you take? Because we've screwed up so bad the last X number of years. I think that's going to be the real conversation.
The reviews of the food on the roadshow. Give us more. Rubber chicken, what else?
Well, no, the problem with road shows, besides now it's all merchant swag and all that garbage. It's like you're going to the Oscars or something.
Just zoom it.
Is if you do it 3 or 4 times a week. That's the issue. It's not like a road. In the old days, there were enough IPOs per week where it was rubber chicken 4 days a week, which is, after the Tuesday.
Is that how Young Keen ate back in the day?
Well, people don't realize this. I mean, there's a prospectus here. It's all digital. Rain Securities is the financial advisor of the Barclays involved, J.P. Morgan. Mizuho is acting as joint book running managers. And Mizuho, I think, is in charge of the tablecloths at the roadshow. The bottom line here is, in the old days, you had a red herring. You actually read it. Some guys read it with highlighters where they could look at the cash flow. It's called securities analysis. I'm not sure what it is with ARM.
You're suggesting there is no security analysis?
I'm not suggesting that. I'm suggesting this is a challenged IPO already. I'm probably going to... Marcus Ashworth is brilliant on this.
No, he has been good, Tom, and I'm with you. Based on what they're looking to raise, it's half what we thought they'd look at.
What do you think, a roadshow?
And looking at the valuation,
the roadshow in London is the Dorchester Hotel with an umbrella and the drink?
Meant to be. The Dorchester?
Yeah, that's where they have the roadshow. They put an umbrella in the drink.
I've not had one of those.
It's part of
going
to London.
Okay. All right. We've got a good guest, Tom, if you want to get to her.
Winnie Caesar here, and this is an important conversation for global Wall Street, particularly the linkage between debt, bonds, and stocks. Winnie Caesar joins with CreditSights this morning. Winnie, just cut to the chase. What is the spread market telling you right now in a given category of debt? What is the difference between great debt and bad debt telling you?
Well, the difference between great debt and bad debt is telling you that things are looking better than they did 12 months ago, for sure. We've seen a pretty nice recovery in the lowest rated parts of the market, the junkiest parts of the market, but it's still not, screaming things are super overheated, super rich, spreads really, really tight. And we are actually seeing that higher quality spreads are still a little bit wide just because duration has had such a challenged 18 months now at this point.
What is the linkage between your world at CreditSights and guessing the equity market? Can you take spread analysis and bring it over to an equity call?
So it's a little bit tricky to bring it over to a full equity call. What we can say is that credit, especially investment grade on a yield basis, looks far more compelling than it has really for the past 20 years relative to equities in terms of S&P 500 yields. And that's one of the reasons that we've remained pretty constructive on credit. We're in kind of a neutral carry-oriented position right now in both investment grade and high yield, because the relative value compared to equities feels like you have some pretty good downside protection in fixed income and corporate credit, but you also get really good carry and yield and income generation right now.
That's the buyer's side. I want to talk about the seller's side. This question of investment grade and high yield bond issuers who are lining up typically a very busy month in September. Torsten Slok of Apollo was pointing that out, expecting it to be the same this year. I just want to start with a very simple question. Why would any high yield company sell debt with an 8.4% coupon at a time where they were used to something that was free? They're looking at an economy with a lot of question marks around it, and they don't need to.
Well, I think that for the high yield market especially, we've seen a bit of an issuer strike for the past 12 plus months because, to your point, they didn't really need to do anything. Maturity schedules had been really pushed out. There's not been a lot of M&A, not a lot of LBOs, not a lot of reasons to come to the market. At this point, though, investors are starting to get a little bit concerned. And so it's almost as if it's a show me story. And so we have a lot of companies saying this might not be the most attractive financing that we're ever going to get, but we haven't seen valuations and all-in borrowing costs come down all that much over the past 12 months. So we should perhaps just raise some new capital, demonstrate to the market that there is receptivity to our company and to our business operations. And then in 2 or 3 years, given that high yield bonds are usually callable, we might be able to refinance at a much more attractive level.
Is it the same story for investment grade companies? I'm looking at a 5.7% rate. Again, significantly higher where it used to be, but less so than in the high yield market. Are you getting this sort of sense that maybe this is where yields are going to be? That corporate financial officers are saying, you know what, this is the new normal and we have to adjust to it?
I think that is definitely happening to an extent. And I think that there's a little bit of a fear in this higher for longer type environment that yields go even higher and all-in borrowing costs go even higher. And so sometimes we're seeing a little bit of front loading of issuance ahead of potential Fed meetings with more rate hikes or more moves upward in the long end of the U.S. Treasury curve. And also the investment grade market just always has a lot of maturities that need to be rolled over. You have a high concentration of banks, which have a lot of regulatory capital reasons to be tapping the new issue market. And so investment grade, they don't have as much of the luxury of waiting as opposed to the high yield market, where you do see those maturity profiles that tend to get a bit more pushed out.
Well, speaking of roadshows and rubber chicken, we were just talking about the ARM IPO. Are bond deals getting done? I mean, are they getting done as they usually are with 5 phone calls and no rubber chicken?
It really depends on the credit at this point. We're seeing some issuers come to the market priced with very little new issue concessions, so not a lot of a discount to existing bonds. And then you're seeing some issuers come to the market and, they could have just chosen the wrong day where the markets are a little bit more volatile. Perhaps there were some negative headlines around China and more macro front. And you're seeing them get punished a little bit with much steeper new issue concessions. But for the most part, deals are getting done. We're not seeing a lot of deals, coming to market and then getting pulled, which is a very encouraging sign and also just indicative of the amount of cash that is still on the sidelines that needs to be put to work in something.
Willie, just quickly, supply this week. Have we got a lot?
I think that we will absolutely have a lot of new issue supply this week. September, seasonally, very strong month, and we do have the Fed and CPI, a few other headline things kind of mid-month, so I think issuers will definitely be looking to get ahead of those events.
Interesting. Might explain the move we're seeing in the Treasury market this morning. Winnie, thank you. Winnie Caesar there of credit size. Often when you anticipate a big slate of supply, Tom, kicks around the Treasury market just a little bit.
It does, and I don't. It's been so long, John, since we had a normal yield environment. I can't remember what CFOs do when yields are solid. There's a real yield out there involved. My answer is they're going to do business as usual, and as she mentioned, there'll be the haves and the have-nots within the bond space. But it's not like there's going to be a panic. OMG, I'm not going to do anything.
No, market's not shut, Tom. It's just more expensive.
Yeah,
that's the change.
Oh, I like the phrase "more expensive" a lot. I think we underplay that.
Yeah. If you're just tuning in, welcome to the program. Your equity market looks like this on the S&P 500, slightly negative through much of this morning. We're down here by 0.1%. Coming up a little bit later, one of the best, one of our favourites, Neil Dutta of Renaissance Macro. For all the doom and gloom out there, the forecast of recession,
absolutely.
Neil Dutta pushing back aggressively through the whole of this year. And Neil, that smile that he's wearing there, TK, I have no doubt he'll be wearing it at about 8:30 Eastern Time.
He wrote 2 paragraphs umpteen months ago and saying it's this simple. Wage growth will be what it will be, and as inflation comes down, the vector is towards increasing inflation-adjusted wages.
Real incomes get better.
He was pretty lonely on that.
Well, I can tell you, Jan Hatzius is basically saying the same thing over at Goldman.
And it was strong language. To your point,
Sure.
You put up the quote on radio, and I believe I'm quoting correctly, strongly disagree with the recession call out there. That's strong language for Jan Hatzius.
15%. I'm always intrigued by these
What is
percentages.
that?
Where do they come
what
from? What
does
is
that
it?
come
Go
from?
15%. Just tell them 15%.
I don't.
Be nice to catch up with Jan, wouldn't it? It's been too long.
Yeah. Well,
Cool. Well, we'll try and make that happen one day.
And Peter Oppenheimer, too, with an important note off the London desk.
I saw that too, yeah. Be nice to catch up with Peter too.
Nice to catch up with him, too.
Alex Webb on the Huawei teardown coming up a little bit later. This is really important stuff. So we get this new Huawei phone, Tom, and we're wondering, well, how is this being powered? Where are these chips coming from? Who's powering it? And then we work out that maybe this has been done on the mainland
So are we
in China.
saying
This is a
that
huge
there's
development.
a secret thing in the chips that can monitor us? I don't think that's the allegation, is it?
No, we're saying that there's been tons of sanctions to slow down the development of things like
And
this,
they're developing.
potentially.
And they're developing.
Sanctions haven't worked.
Doing it.
Yeah.
Sanctions have failed, and I'd go one step further. They released it when the Commerce Secretary was in the United States, Tom, had left the US and was in China. That to me is just an amazing turn of events. Futures right now slightly negative from New York. This is Bloomberg.
What is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, aren't you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
In China, they have their structural problems. After 30, 40 years of an economic wonder, they're reaching also, I guess, a level of maturity where you're dealing with structural issues as well. So I think we have to take a little bit of a cautious stance on that and see how things develop and not expect rapid growth as far as the economy is concerned in the short term.
Ola Kalenius there, the Mercedes-Benz Group CEO, speaking at the International Motor Show in Munich over the weekend, catching up with Bloomberg's Ollie Crook. It's EK talking about a weaker Chinese economy. What about the stronger Chinese competition domestically for some of the automakers over in Germany?
Yeah, I'm going to step away here from the technology. It's a 7-nanometer processor. Vlad Savov and Debbie Wu showing they're smarter than I am. And, I learned a long time ago, listen to the pros on chips, and I get the feeling that pros have sort of been surprised by this.
I was talking about cars, but you want to talk about Huawei?
I would talk about Huawei.
Okay, great.
I think
well,
that's the technology lead.
Sure.
I
agree. The top chip maker in Huawei, top chip maker in China, Tom, coming up together with a fancy processor. What's the phone called? The Huawei's Mate 60 Pro.
Yeah.
You think Apple should be worried about that?
I don't know if they should be. And Alex will tell us this, but John, you've been leading on this, and you're right in that. We're not supposed to give them technology, but why do we worry if we give them technology if they already have the technology?
Alex Webb joins us now to discuss the Bloomberg Quick Take. Alex, are they getting that done themselves?
Well, that's the real news here as it's evolved over the past few days. I was talking with you about it a few days ago, just before the weekend, and we were asking, well, is this just chips that they have left over from TSMC from before the sort of sanctions kicked in? This teardown that our colleagues had done on their behalf shows that it is a chip made by SMIC, which is essentially China's homegrown competitor to TSMC. TSMC, which is the maker of chips under contract for any number of people from Apple to NVIDIA and beyond. Well, SMIC makes chips for other people's designs in China, and the teardown shows that this chip made in the 7-nanometer process is made domestically in China.
This is quite a statement, and we can talk about different dimensions across national security, geopolitics, the relationship between the US and China and sanctions. Alex, can we just focus just briefly on Apple and the competition they might get for the new iPhone that's unveiled potentially in a week or so?
Yeah, it certainly feels like it's a little bit of competition for Apple. The key question is, have they been able to make these chips at scale, right? That is what TSMC can do. A lot of people are very skeptical about whether SMIC can do that. And if they can't, well, then the next iPhone, which will be unveiled shortly, is unlikely to have significant competition. Nonetheless, sales in China have been slowing for Apple, partly as there's broader competition. The final thought, of course, is that if Apple unveils a new chip, which is made on the 3-nanometer process, that is quite a lot further ahead than what's happening in China right now.
Okay, I get that, but that's the heart of the matter, and it's a brilliant. The Bloomberg story, folks, with the photos of the teardown of the phone and everything is just absolutely world class. Alex, that's the heart of it. They're doing 7-nanometer. Apple's doing 4-nanometer, and Apple in September now is going to announce 3-nanometer. What's your belief of their technology speed to get to 6, 5, 4, 3-nanometer?
It's really, really hard, right? Because when we talk about the machines that are needed to do this, the extreme ultraviolet lithography machines, they can etch laser patterns that are incredibly small, that sort of 3 nanometer scale that you're talking about. Well, there's one company in the world that can make them, ASML in the Netherlands. But even more significantly than that, there are a bunch of companies in the supply chain for ASML, on which ASML has a lock. You know, they're in Germany, they're in Japan, they're elsewhere. Those companies in the supply chain are ones that China also doesn't have access to. So it's hard to get there. Getting to 7 nanometer, it is impressive. They managed to do it, particularly if they've done it at scale with this device. But they are perhaps 1, maybe even 2 generations behind.
What do you make, though, of what John was talking about, that this did come out when Commerce Secretary Gina Raimondo was actually touring China? It was a clear question mark. It was a clear statement that it is not affecting us, that you're trying to sanction us and keep us from some of this technology. How far does it go as them as an export vehicle, as a real major competitor on this scale versus just a comeuppance to the U.S.?
Well, when we think about Huawei, the devices, yeah, sure, they're interesting, and we think about Apple, but the real strategic value of Huawei is in telecommunications network equipment, right? They are the biggest player in that space, competing with Nokia and Ericsson. That is something that potentially gives them a huge amount of global influence, because they're building the 5G networks in sub-Saharan Africa, in parts of Asia. They have been blocked from the networks in much of the rest of the world. If they can't get the bleeding edge chips for those applications, that is a huge blow to their global ambitions. And it is something that affects their ability to have, for instance, the access to cloud computing, the best 5G antenna at the edge of their network. So that is the real value here, rather than in the consumer devices.
Given the fact that China is clearly developing its own technology and wants to prioritize that, there was even this council that was just created to help support private businesses in China. What does that mean for Apple and their Chinese business?
Look, China, it is a symbiotic relationship that Apple has with China. It is not really in China's interest to somehow kneecap Apple, because it employs upwards of 1 million people in China, right? So China needs Apple, Apple needs China. The likelihood of that breaking anytime soon seems minimal. Apple devices are still hugely popular in China because they've been building this ecosystem for a lot longer. So is it going to hurt them around the fringes? Maybe. Is it going to destroy their business there locally? It would seem highly unlikely.
Alex, we could have you on for an hour this morning. There's so many stories flying around. John's been so out front on Huawei, I got to stay there. A nanometer, which I have I don't have any sense of what a nanometer is. It's 1/1000th of a meter, 10 to the minus 9. A human hair, John, is 100,000 nanometers. Pull that science over to our worries about defense technology in the Chinese. How do you get from Huawei in a 3 nanometer future over to our worry about satellites and spying and the rest of it?
The real conversation right now around the bleeding edge semiconductors is to do with AI, right? That to be able to do process AI functions with the energy efficiency and therefore cost efficiency that make it worthwhile, you need to be at this very, very, very small scale. And the argument that the US has been making is that doing this is actually stopping stopping the Chinese more broadly from being able to compete in that space, right? The others will say, oh, it's actually just about the Chinese economy as a whole and trying to prevent them from usurping the US. There are a lot of things that China is going to find hard to do when it comes to the AI revolution if it doesn't have the best semiconductors. There's lots it still can do, of course, but the most recent round of sanctions, the US has said, well, actually, we want to ensure they can't get access to cloud computing, right? So it's all very well saying, well, we're not going to let these things go into China, but if China can use cloud computing or cloud servers that are located in, for argument's sake, Singapore, well, then it all becomes slightly redundant. So the US has stopped their access to that as well. It is all about that next generation of AI innovation and what those applications are for.
Just on chips, just on advanced technology, let's just do this in years and sum it up. Alex, how many years behind do you think the Chinese effort is now, relative to where we thought it was?
I mean, look, it's hard because there's so many different pieces to this puzzle.
Sure.
You could say, look, 7 nanometers have been around for in sort of broad like large-scale applications for maybe 6-7 years, right? So that's where they are. That's where they've got to. Getting to that 3 nanometer is a lot harder because the hurdle of getting into extreme ultraviolet lithography is massive, right? That is a big leap to get to that point. Lots of people were skeptical that EUV would ever happen. In fact, that's one of the reasons that Intel kind of missed out on it, that they were not convinced that it would ever be possible. It ultimately proved to be the case. There is a long way to go from this to the next phase.
Alex Webb, thanks for the update. The update out of London. TK, this is quite a win for China versus the United States, that's for sure, bottom line.
I think it's a huge wake-up call, and I really, again, the Bloomberg article is just absolutely superb out of our Asian effort. And Alex, educate me on, where they are. And my answer is they go from 7 to 6, and then they have this process lithography, whatever it is, where they get to 3. Why won't they be able to do that? They've been doing it for hundreds of years. I mean,
and they do it so quietly.
They
did it so quietly in the last week. Yeah. Secretary Raimondo comes over there, starts preaching about what they need to change to make the country investable again, and then they just quietly release this, Tom,
well,
under the radar.
There's a number of stories here involving politics and that, but just on raw technology, I don't understand how this goes over to our legitimate defense worries about China.
And they are legitimate.
Like submarine telemetry, just talking off the top of my head. I don't know where this heads. It's a phenomenal story. I'll put it out on Twitter here.
Coming up in the next hour, Chris Heisey of Maryland Bank of America Private Bank. That conversation up next with futures right now. Slightly negative. We're down by 0.1%.
World of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power in the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lines.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. It's not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
We've all been there. You get invited to go to Kyrgyzstan, where you're turned into a YouTube kids show star. Build a satellite and play a game with a goat. The point is, Hello World is back, and you should watch it. Thursdays on Bloomberg Originals and Bloomberg TV.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
The distortions in the labor market are gradually wringing themselves out of the system.
The labor market is gradually softening, but not cratering.
This is exactly what the Fed is looking for in terms of getting the normalization in the labor market.
The labor market holds the key to whether you can pull off that soft landing.
Over the course of next year into 2025, I think employment is going to continue to slow. The Fed's going to get its way with the labor market.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene all together, back together. Again, it's back to school. It's back to the real world of equities, bonds, currencies, commodities. 18 stories to talk about this morning. John, real simple. The real yield buttressed right up against the high seen middle of August. I got a real yield 1.94%. That's a ginormous statistic this morning.
High for longer, but maybe not higher. Seems to be the take at the moment. September off the table after the data we had from last week, September 20th, the decision from the Federal Reserve. That may be still hanging, Tom, lingering
When's
around
inflation?
CPI.
13th, day before ECB.
Of September. So next Wednesday.
Yeah.
ECB on the 14th, next Thursday.
It's going to be an extravaganza before we go to London here. And, you know, I'm sorry, you get an inflation surprise.
Oh, we're making the London announcement.
Well, of course we are.
Don't slip that in. What are we doing over there?
Well, the tots, I mean, the schedule, I'm really looking at like Arsenal.
We're going to watch football. We're just going for the North London
derby. Yeah, we're going for the derby.
Okay.
Lisa's going to come too.
Does Bramo know?
Thanks. Bramo's, yeah, three of us.
Okay.
Arsenal,
Great.
Football, red. They wear red.
Thanks, so
Everyone
great.
I know.
Bramo's an Arsenal fan.
Yeah.
Everybody I know is for Arsenal.
Yeah.
Over there.
A gunner.
That's a gunner.
Bramo's a gunner too.
Kit Jukes.
There you go. Kit Jukes is also a gunner.
That's where we are. But John, I think
Good to know.
it's a toxic brew of post-Labor Day stories this
But
morning.
it hasn't been that toxic.
No.
In fact, you would have to say the doves on the Federal Reserve have more ammunition after the data of the last week. And I can share with you some comments from the likes of Mike Gabe and Bank of America saying that the labour market, supply and demand coming into balance a little bit more. Alan Zettner and Morgan Stanley had this to say: the report continues to point to a labour market that is softening but not falling off a cliff, keeping a hike in September off the table in their view. They're not alone. But then you introduce Tom, and I think this is the conversation we'll have this hour. Goldman Sachs saying 15% chance of recession, that the long and variable lags may well be behind us by the time we get into 2024. Neil Dutter of Renmac, that conversation 28 minutes away. He's talked up an economy that's outperforming, above trend growth, that could well reintroduce inflation reaccelerating at a Fed that may well have more work to do.
But Lisa, if it's not 15% recession, it's 85% what, if I did the math right?
There's a theme emerging this morning, and I think that it's not a toxic brew at all. It's the opposite. But there's a question of what this looks like. And we heard from Steve Chiavarone of Federated. He's bullish on U.S. equities because it's the area of growth. And then we heard from Katie Kaminsky that this could mean that bond yields are higher for longer. You put these two things together, this idea that you don't necessarily need to see the Fed cutting rates anytime soon because the long and variable lags aren't that long, aren't that variable, like Goldman Sachs had to say. So that leaves us in a new rate regime, and people are sort of going back to that idea.
Overcome by events. Katie Kaminsky, I adore. I love her trend-based work. John, 88.41 on Brent crude, and she made clear that's a trend. Alpha sites, whatever it is, they're
Alpha
looking
Simplex.
at. Alpha Simplex.
Alpha
What's it?
size.
They made,
You two get this settled, and then I'll jump back in.
They made semiconductors.
Okay, oil. You want to talk about Brent?
Brent crude.
Do you see the move in crude as a reflection of economic improvement, this expansion going longer than expected, or a reflection of what's happening on the supply side?
I look at it as
if it's the demand side,
post-COVID.
okay, if it's the demand side, Tom, then maybe you can make the argument the Fed might have more work to do here. If it's the supply side, then it might be the recipe for a slowdown regardless. I think how you frame this, Tom, is important. The move in the last week, lots of people might say that's down to Russia cutting back and maybe the Saudis set to follow going into OPEC. But, Tom, I'm with you. Iron ore back to April highs.
Exactly. Thank you. I looked this morning.
There's a lot out there on the commodity side
How do you
suggesting
search for iron ore on the Bloomberg? You just go iron ore?
It used to be Tianjin. It used to be a different... I used to look at a different benchmark.
I agree. Different benchmark. But let me open this up because I didn't get to ask one of our guests this. What's the gloom trade right now? What's the weight of people gloomy on the market? I can't get a handle on that. I mean, how many people are gloomy on the stock market?
So Jim Bianco of Bianco Research is going to join me later on the bond market in about 55 minutes. And what is consensus right now? Jim believes consensus in the bond market is still bullish, long, yield slower.
Yeah, and we heard some people pushing against it. But
he thinks you should lean the other way.
What's the gloom bet right now in the stock market? I don't have a handle.
There are people who come out and say that there isn't one, and that's been a problem for them, that they'd like to see more baked in. And then others say, if you look at the options market, it's not as rosy as people previously expected. So there is enough gloom to make some people bullish even further.
We pulled back when you guys weren't here Friday from a 13-level VIX to 14.19.
This is market roulette this morning, TK.
It is. I mean, the VIX is 14.19. I mean, it's gloom out there.
I'll throw the euro at you.
Thank you.
Euro just about holding on to 107 at the moment. It's on 107.34.
I agree.
Near session lows.
Right now,
0.6%.
Our guest is so important, we've got to get to him right away. James Caron is CIO of Portfolio Solutions Group at Morgan Stanley, with decades of experience on his bond market, and also it folds into everything else. Jim, we're playing data roulette here, as John puts it this morning. How do you interpret Brent crude on the edge of a moonshot up to near $90 a barrel? How does that change your world?
Well, I think, when I think about oil, I always think about the demand that goes into it, right? So is this a sign? I mean, clearly there are technical indicators for oil in terms of supply and demand. All that stuff goes into it. But could it also be that global demand isn't as soft as people think? I mean, yes, things are slowing down, but could it be that the production isn't enough to actually sustain, a softer landing, whether it's in the U.S. or even globally? Yes, things are slowing, but they're not collapsing, and I think that's the key. And I think that's one of the things that's probably going to be somewhat supportive of oil, that plus some of the technicals in terms of the undersupply.
Jim, let's talk about the equity market. You cover that now too. We spoke to Steve Chevron of Federated Hermes. He reckons this rally has got legs. Do you share that belief that maybe this rally has got legs? I remember conversations that you and I had at the start of the year, and we were talking about risk, and you made the point that downside risk is something we're all talking about. Upside risk is something we need to appreciate a little bit more. What about now, Jim?
Yeah, I'm still in that camp. I mean, look, I want to be very clear. I do think the economy there is a slowdown that's underway, that there's no question, but I don't think people are positioned for it. And I think that's one of the real key factors, meaning that when we look at equity positions right now, positioning in equities, I should say, isn't necessarily overly long. So therefore, the market's vulnerable to move higher on modestly good news or less disappointing news. So look, take 2Q earnings. 2Q earnings were supposed to be down 7%. They came down to 4%. Okay, that's not a good number, but it's a lot better than where it was or what people were thinking. And if we think about the third quarter earnings might be flat to slightly positive. This could be the inflection point, and this is something that investors typically like to buy into when there's an inflection from negative earnings growth to potentially positive. So, and given the fact that people aren't overly positioned long in equities right now, then I think that there could be some possible legs as long as we don't get the disappointment.
Well, what disappointment are we really talking about here? Are we talking about the disappointment in earnings? Or are we talking about the disappointment that, oh yeah, if growth can continue to keep chugging along, even with yields where they are, maybe yields can stay here for that much longer and even go higher, the Katie Kaminsky view of the world?
Yeah, so that's a great question, Lisa. So I think you're right. I mean, it's the disappointment in the growth, right? So right now, everybody's focused on, a recession, an upcoming recession that's supposed to happen. Yet, third quarter GDP estimates are being upgraded, not downgraded right now. So, okay, we may be slowing, but we're also getting some pretty good tailwinds that tell us that the slowdown in the potential economy, going forward into the fourth quarter and maybe into early next year might not be as bad. So I have a lot of sympathy for what Jan Hatzius at Goldman Sachs is actually saying, which is that you could have a softer landing here. And I still don't think people are positioned that way. So something that John and I was speaking about at the beginning of the year was that risk on is a risk, and like any other risk, it needs to be hedged. And I don't think that people have enough risk in their overall portfolios in terms of the balance of equities relative to fixed income. I still think that, people believe it's the year of the bond market and that bond yields are going much lower. I kind of lean against that too, sort of like my colleague Jim Bianco does. I think that we could be getting a little bit of a push higher in yields.
Okay, so this really is the question. If you believe in Jan Hatzius's view of the world, you also believe that the long and variable lags has been overplayed and that that's actually not really going to factor into any kind of slowdown, that what you see is what you get in terms of the strength?
Yeah, so that's where I push back a little bit on that call. So essentially, the fact of the matter is that interest rates are high. Financial conditions in that sense should be tightening. I mean, certainly the banking sector and what have you. So it's not like that just goes away, right? So it's not like those long and variable lags in that sense go away. But the long and variable lags in terms of whether it could be potentially employment, it could be growth in other sectors of the markets, particularly the value sectors of the markets, those sectors could actually stand to do a lot better. So while we're looking at very sector-specific areas like, growth and technology, which have done, very, very well this year, certainly those may still get impacted later on. But I think the broader sectors of the marketplace, like the materials, the industrials, and even some of the consumer staples and discretionary, could actually start to do better.
Jim, just quickly, November hike, still in play?
Not in my mind. Not at this point. We would have to see some change in the data.
Okay. Jim Caron there of Morgan Stanley. That next big data point, September 13th, a week or so away. Just going into that ECB meeting on the 13th is the CPI report, Tom. September 14th is the ECB meeting.
Well, we got a whole bunch of dates coming up here. We got September 13th CPI, September 14th ECB. More important, September 17th, Formula One in Singapore.
Nice.
Which will be interesting as well. Then we got the 20th, which is FOMC. And, I think Arsenal we can make. The three of us would be great.
Is that the 24th?
24th, sort of
something
on the way
like
to
that.
Heathrow. And then the 30th is Liverpool is at Tottenham.
Didn't know that. Okay.
Today is like the 104th, whatever, anniversary of the advent of the Tots. So,
Are you celebrating?
Well, no, I was going to take the day off and celebrate, but I got to be out tomorrow. Afterthought starts school tomorrow, so
okay. So you're taking tomorrow off?
Yeah, you walk. Well,
so you drink
actually,
tonight and
you don't walk them
toast
to
the club?
John. You don't walk them to school anymore. They walk 6 feet in front of you, so they're not with you.
Well, when they're teenagers, that tends to happen, Tom.
They walk like 15, 20. Hey, you.
I think it's sweet you're still walking them to school.
It's very
sweet.
Yeah,
that's very kind.
She's got a lifetime pass.
Grandma will be here.
Yeah, I will be here for the first day of school.
On your way, children.
100%.
If you're just tuning in, welcome to the program. The S&P are negative here by 0.1%. Coming up a little bit later, Neil Dutt of Renaissance Macro, 8:30 Eastern Time. Tom, 17 minutes away, just defying the gloom, the doom in this economy. Neil's call all year.
Whether you are cautious or not, this is the conversation of the day, as Mr. Dutta rephrases his brilliance of 18 months ago. He really was extraordinary. He was lonely.
But he's not lonely anymore.
Not lonely anymore, no.
Not lonely at all. Coming up in the next hour on Bloomberg TV, going into the up and about, Jim Bianco of Bianco Research, Stuart Kaiser of Citi, Tiffany Wilding of PIMCO. PIMCO early this year, the middle of this year in June, put out their secular outlook, and led by the former Fed Vice Chair, Richard Clarida, talked about tolerating 2-point-something. 2-point-something and tolerating that inflation level, Tom, I think has quickly become the consensus view amongst a lot of people going into year-end and into next year.
The former vice chairman leading on that, and I'm going to go back to the 10-year yield as the barometer, the real yield 1.95%. Ian Lincoln has it up 2.0-something% is maybe his upper bound. History says we get back to that. There's a raging debate about what the real yield does here in the Q4.
The question is, particularly going into an election year, is this Fed willing to destroy the labor market to get inflation down 100 basis points? That's still the question, isn't it?
Yes, it's still the question. Andrew Hollenhorst was brilliant last week when you were not here, and I mean, the fact is, I'm looking forward to Stuart Kaiser. I think
just to be clear, you're killing me for taking Friday off. You're off tomorrow.
I'm off tomorrow.
Okay, and I will miss you. From New York, this is Bloomberg. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Thursday, Bloomberg's Mike McKee sits down with New York Fed President John Williams at Bloomberg's Market Forum for an exclusive interview. Does he see more rate hikes? How soon for cuts? Find out Thursday at 3:30 p.m. Eastern, only on Bloomberg.
We want to connect this inflation story. The thing we're watching is the oil market. The reason that is important is because that is one of the indicators, at least when we've seen inflation data down the pipeline. Brent crude has been one, for example, in 2022, that tends to be something to follow as a catalyst into where you start to see inflation numbers tick up later in the year.
On fire this morning, Katie Kaminsky really talking up the trends that she and Alpha Simplex see. And as we mentioned here 10 minutes ago, really extraordinary her view on the trend based of oil. Right now, let's quote that for you. American oil, so it looks like it's a Brent price, $85.29 on West Texas Intermediate, $88.38 with a dash near 89 earlier this morning. I'm Brent Crude. Lisa, you and I were talking about this on the break, and to me, it's the story of Q4 that's undermodeled right now is how I'd put it.
I could not agree more. Honestly, it's not just the oil sector. We've talked about some of the other commodities as well.
John mentioned iron ore.
Iron ore,
yeah.
Also food. And you've seen this in emerging markets really creep up where food costs are going up significantly. At what point does that challenge the idea of this disinflation in the U.S. if you have gas prices, if you have oil prices climbing at a significant pace?
Yeah, I want to mention right now along that line, as you mentioned food here, my book of the year has just come out in the last week. It is hugely anticipated. This is Robert D. Kaplan. He's had my book of the summer and book of the year before, and he is absolutely exquisite on geopolitics. It's the loom of time, and I just really can't say enough about it. I put it out on Twitter last night. I'll do it again here.
Especially at a time where you see rice in Southeast Asia,
Yeah.
prices climbing back toward the highest in 15 years. Just a changing dynamic around the margins that isn't getting talked about a lot. Maybe it's just because of the supply side. Either way, what that does going forward could shape at least the next couple of months.
Right now, we're going to frame out your next couple of months. There's a loom, Robert D. Kaplan, The Loom of Time, folks. On radio, it is absolutely brilliant, 300-plus pages, a tour de force by Kaplan. You know him from Marco Polo's world from a number of years ago. Right now, in the equity markets, we frame it with Chris Heisey, Chief Investment Officer of Merrill and Bank of America Private Bank. Chris, I love your note. You've got to participate, but you're scared stiff. How do you participate in equities if you're scared stiff?
Yeah, I think you have to first start with a plan. You can't go into anything where there's a lot of cross currents without a plan. So you also almost have to have an understanding that you're going to have a lot of choppiness in the markets, particularly when you've got cross currents, whether it's inflation, the energy markets, food prices, the labor market, which is now normalizing again, and almost back to normal, frankly. And then finally, you've got a slowdown in China. You still have the war in Ukraine. There's so many things to fear. So you want to look at weakness in the markets, use it as a dollar cost averaging approach. We call this a market environment overcast. It's not sunny. It's not raining. And those are the markets that kind of, dismay you. They make you stay on the sidelines longer than you should. So have a plan, be ready. And in particular, you shouldn't be underweight equities at this point in the cycle. That's our plan.
What point in the cycle are we, Chris?
Well, that's a good one. It's blurred lines between late and somewhere in the limbo part between late and early. We're all waiting to see the signs that the Fed is done. But unfortunately, when the Fed does cut, they usually cut for a reason. And that's usually because growth is coming down sharply. The labor markets have already peaked as in terms of employment. And then ultimately, they have to do something. So everyone's thinking that that's going to be in the spring of next year. We don't really know when it's going to be. No one will know until the data starts to pull through that way. And at that point, that's when you should start to see earnings begin to discount something better on a second half of 24 basis. But markets don't wait for that. We all know that. So the second or third cut is usually when markets begin to climb that wall of worry. So between now and then, we're in limbo. And that's like a late cycle type of move.
And we are seeing right now, at least according to some estimates, that Wall Street is raising quarterly profit earnings at the highest pace going back 2 years. So that's sort of where some of what you're talking about does come into the fore. That said, is there some sort of incoherence here with this idea of betting on rate cuts at a time where growth is continuing to chug along? We've got concerns about commodity inflation, and a lot of people are saying higher yields for longer seems like the most likely outcome going forward.
That's such a great question, because this is the whole issue that's going on and why there's still so much cash at the short end of the curve. This is not a normal storybook. The distortions coming out of the pandemic and through the pandemic have basically balanced out a lot of the things that would have normally happened. So you've got this overage in some places, and then you've got this slowdown in China mixed with whether or not the Fed is going to continue to keep real yields where they are or actually expand them. So for what it's worth, I think the earnings side of the equation, most of Wall Street believes that the second quarter was the trough. Our view is going to be it's going to be a bumpy earnings progression. And then ultimately next year, you start to grow again for real. This point in time in the cycle, you generally get better economic numbers right before you don't.
Chris, I want you to address a traditional 60-40, or dare I say 60-30-10 allocation in the partial differential of cash right now. Now, buttressed against that in the equation is a 5% yield on cash, money market, whatever. But how do you utilize cash as a tool to get out 3 years to that equity optimism?
Tom, that's perfect. Cash at the short end should be used if it's investable. In other words, if you're waiting to invest those dollars, that cash 5.5% should be viewed as cash flow for investment. So if you get weakness in September, which you typically do, right around potential worries of potential government shutdown, use that cash flow into the equity markets, particularly if you're underweight. And then over a 2 to 3 year period where earnings are now back on track, they're growing again, the economy is away from the distortions. So we use that as a tool. That's a very good way to think about it.
What do you say to people that are just downright cautious on the market? We have coming up, folks, in about 25 minutes, David Rubenstein, and we will talk about the wonderful Jeremy Grantham of GMO. And Jeremy Grantham has been really, really cautious on stocks for a really long time. I'm going to call it 3 years. How do you address those people and say, you got to participate if you want to retire, if you've got goals down the road?
And I think number one, I think it's important to understand that all different types of cycles have different catalysts to them. They may be core in their nature as to how it works, how money flow works, from one asset class to another. The relative movement of yields relative to the earnings yield in the S&P. All those things are fundamentally fine as it relates to how to think about it. But there's major drivers of this new economy. I would argue that the innovation cycle in this new economy, and even in the last decade or so, constantly reinvents itself much quicker than ever before. So you can go into a new profit cycle much quicker. Therefore, the valuations in this type of market almost have to be higher than traditional cycles of the past, where you didn't have the same innovation speed that you have today. That doesn't mean it's completely different, but it certainly means that there's always something to worry about. And usually when the worries are so high and those worries don't pull through as large as you expected, you get a good market.
Chris, thank you so much. Chris Heiser with us with Merrill and Bank of America Private Bank. Lisa, to go from Jim Caron, who I thought was fabulous across asset, to Chris Heiser, who's talking to people, what do I do forward, whether they did get the bull market of October or the 2-year bull market, and then to go to Neil Dutta coming up, who's an outright optimist. It frames people that are almost frozen, and you got to say, let it go, you've got to invest. But the percentage of people out there frozen right now is substantial.
None of those people were frozen. They were saying you need to own bonds, you need to own stocks rather, and you need to go in
But that's their
more
job. I
significantly.
mean, come on, they're talking their book.
Well, to some degree, but you heard earlier this year, be cautious, be cautious, be cautious. Cash is good. And now you're not hearing that. You were saying earlier, why can't some of these stock bulls get some love? They are everywhere. I think it seems like a lot of the strategists are saying it seems like this does have room to run. I just think it's a confusing economy right now. I don't think that anyone really has a handle on exactly which cross current's going to win out.
Shout out to our team for a set of great voices as we come back from summer. Bramo's back. Summer's over. It's time to get down to business. We've got some great voices. Neil Dutta coming up as well. Stay with us. Futures, -10. Good morning.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly with just a couple people. Our average restaurant now does about over $1 million per restaurant in digital sales.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
I think of myself as a realist, trying to see the world as it really is and not the way I'd like it to be. And sometimes I succeed and sometimes I fail in that.
Bloomberg Surveillance, and we say good morning to you, good September to you, good back to school to you. It's sort of New Year's. I've always felt that this is New Year's. Maybe not now, maybe it's Wednesday or Thursday or
maybe when the kids actually leave.
With a new thing, September 15th. We're going to be going off to London. We are thrilled to tell you that Surveillance, the entire team, we got 40 people on a plane. They're actually on separate planes. Lisa, John, and I can't travel together. That's part of our agreement. There's too much risk. But we're all going to London. It's like 40 people, and we're just going to have a hell of a good time talking to British voices. And this comes off, I believe, we were on the plane the day after the ECB meeting, so it'll be interesting to see.
Yeah, immediately to get on-the-ground response to what Europe is doing, even though that's not the Bank of England. Team coverage of ECB decisions and what we do with the Bank of England.
It's going to be interesting to see, and over the weekend, there's so much news over the weekend, Lisa, but one of the things I saw, and I thought the FT coming out of London, not on Labor Day, did a great job on this, the miss on growth in the United Kingdom was biggish. It was demonstrable how much better the United Kingdom has done versus the gloom that was out there a year ago.
Did you see services PMI coming out today at the UK? It was very different than what we saw out of the rest of the European region because they actually outperformed. Look, I just really can't say enough that Diane Swank on Twitter, when she came out and she said, I am humble enough to know what happened these last 3 years was complex and interrelated in ways we will be figuring out to a long time to come. This is a complicated moment. We hear about tech innovation. We hear about some of the psychological impacts from COVID. We think about the decoupling of global economies. You put it together and you have a stew of uncertainty that's leaving a lot of people thinking maybe we're even starting a new economic and market cycle.
Or given the shocks you mentioned, a partition between the tech haves and the after COVID haves.
Yeah.
And on the other side, half of America, as a generalization, flat on their back, even given a 3% GDP, which is ample, is quite good.
What do you do with that, right? The people who are getting massive wage increases. Well, and this is going to be a really important question. How has the economy really left some people out of the workforce in a material way and in perpetuity?
And perpetuity was October of last year when all of us were gloomy. Even I was gloomy. Bram was leading the charge on that and dead on into the really difficult September of 2022. And then there was something in the air. In the equity space, we heard it from the technical analysis giant, Ralph Ancampora, Edward Yardeni of Yale, CJ Lawrence is his own shop. On top of it, get into the stock market in October of last year. And on the economic side of Y equals C plus I plus G plus NX was Neil Dutta, very lonely at Renaissance Macro a year ago. We're really coming on a year ago, Neil, from your Arch call. Let's review. What did you see in September of 2022?
Well, thanks for that intro, Tom. You always make me look better than I actually do.
Yeah, we try.
So I appreciate it. But, I think for me, it boiled down to something very simple, which is wage inflation was hanging in there while price inflation was coming down. I mean, that was the principal risk to the economy in the spring of 2022. You had a very aggressive Fed. You had rising food and energy prices that shocked household incomes due to the Russian invasion of Ukraine. Of course, as we got towards the end of the year, a lot of that shock had gone away while the labor markets were still kind of hanging in there. So real incomes were climbing. And that meant stronger consumer spending ultimately, and that's why the economy sort of there. And of course, remember early in the year, Tom, everyone was betting on a Fed pivot, and we saw a very, we saw a modest decline in mortgage rates as a result of that. But that modest drop elicited a fairly robust response in housing market activity. So there's a lot of pent-up demand there for housing. And so I think, when housing is working, it's difficult to be very bearish on the economy.
If we have disinflation or leveling of inflation, what does nominal GDP do? Because top-line GDP, your real GDP optimism with whatever inflation is, linked into revenues of corporations. What's the data nominal GDP call?
I mean, it's at least 6%.
Wow.
I mean, if you believe the last employment report, when you look at aggregate weekly income, aggregate weekly payroll, sort of the sum product of jobs, hours, and earnings, over the last 3 months, that number is up 7% at an annual rate. So, the labor market sort of impulse for nominal growth is quite strong as well. So we have an unsustainably strong economy still. And this is happening at a time when the Fed is taking, steps to the exit door. So, to me, I think the risk, and this is what I think makes me not an optimist, is that the risk is that, the Fed is prematurely declaring victory. I do see a lot of cyclical momentum in the economy right now, and the Fed stepping back. I think that could set us up for a problem as we go into 2024.
Neil, the fact that you said an unsustainably hot economy, an unsustainable level of growth in the U.S. raises this real question. What's going to make it unsustainable? Is it the inflation story that you see as resurging? We've talked about this before, and the fact that the Fed's not there, or is it just that you cannot continue in a vacuum? So at some point, it's going to implode on itself.
Well, I don't know that it'll implode on itself without the Fed doing something about it. And of course, the problems for markets are always when there's a disconnect between what the Fed wants to do and what they should do. That's when the problems come up. And, I think the Fed should not be signaling rate cuts next year. I mean, that to me is a bare, that's like a easy first thing that they should do, is not signal rate cuts. They need to maintain a tight monetary stance because, frankly, real GDP growth is running, last I checked, 6% at an annual rate over the last 3 months. Now, you can talk about revisions, you can talk about, that's not where the underlying growth rate is. But if you look at monthly GDP as of July, over the last 3 months, ending in July, it's up 6% at an annual rate. I know that's not the underlying trend, but it's above trend growth.
Well, and this is the reason why a lot of people are talking about the same thing that you are. We heard from Katie Kaminsky over at Alpha Simplex basically saying the same thing that you are in different ways, and she's bearish on bonds because she sees this coming to the fore and yields having to remain higher for longer. There is a question, though, embedded in Goldman Sachs's discussion of the long and variable lags, and maybe this is an economy that can shrug off a 5% Fed funds rate, and it's not going to matter. So at what point do you see higher bond yields as not inconsistent with higher stock prices, with higher valuations, with a continued rally in the equity market?
Well, I mean, I think right now the combination is reasonably good for stocks, right? Because the Fed is backing off and you have strong growth, and that's so the Fed's sort of off your neck, I think, at least through the end of the year. I mean, if they're going to hike again, it'll probably be in December. So I don't really think we have to worry about the Fed until then. And this is happening at a time when there's cyclical momentum in the economy. The fact is that goods spending, consumer spending on goods, is up over 3% against last year. And during that time, non-farm inventories have been contracting around 0.5 percentage point on average per quarter. Again, that's an unsustainable drawdown in inventory. So what are you going to see? You're going to see inventories restock. That's going to buoy manufacturing production. Again, cyclical industries. So that should be good for equities. The question is, when does the Fed wake up and realize that long and variable lags are not working out as neat and cleanly as they have in their in the Furbis model.
Based on the
And
6%
when they realize
concept.
that, they may have to step on the brakes even more so.
What does that mean, right? And that's exactly where I was going to go. How high do rates have to go in order to curtail some of what you see as unsustainable growth in the U.S.?
I mean, to me, I think that you need to keep the possibility on there for them to start to hike again in the first half of next year. At a minimum, they're going to price. I mean, I think they have 4 rate cuts priced into the summary of economic projections right now. It's hard to see that surviving in September. So, I think let's start there.
Neil, in the economics textbook, chapter 23 or 24 links all of this econobabble into the stock market. Take the Dutta optimism, and the corporations are going to have to deal with an improved real rate. They're going to have to deal with a high nominal rate, on 3 years, 5 years, or well. How does the stock market respond to that? How does the stock market react to an overweighted, optimistic Dutta world?
Well, so I think you could call it sort of an inflationary boom. I think that might be what we're returning to. And if that's the case, that's an environment where stocks can work. But it's unambiguously bad for bonds. But for stocks, I think it's an environment where you should see continued positive returns, maybe not, somewhat below the historical norm. Obviously, if you have higher real interest rates, that hurts equities. But if you have continued growth in the economy, that means that actual and projected earnings will hang in there. So
just because of time, I got to get this in. How is an inflationary boom different now from the horror of the 60s? Well,
that was obvious. Well, the horrors of the 60s. I mean, the 60s were a reasonably good period for stock market returns and the economy. An inflationary boom, again, as I say, is something where equities can work. What you don't want is stagflation-like conditions, where productivity is coming down, where you have repeated supply shocks. That's an environment where bond returns are horrible, but stock returns are as well, because companies can't find a way to make money in that environment.
Neil, your Q4 GDP number right now. We got to get Brammo going. What's your Q4 real GDP number?
I mean, we're running so strong right now. But I think we probably slow to something like 2.5 in Q4. I think what the consensus is missing right now is that we're going to have a very robust inventory restocking on our hands. That's going to bleed into measures of factory activity.
Neil Dutta, congratulations on your economic work. He's with the Renaissance Macro Research as well. So there it is, Lisa. That's a glass half full feel. And, well, yeah, I think it is. I mean, it's a guy looking for legitimate economic growth. I don't think it's just not stagflation. If you got a 2-3% GDP pop, 1%, yeah, you got my attention.
One of the tensions, though, that we've seen that all morning is that there is this optimism that the U.S. equity market can continue to rally and that the U.S. economy can continue to grind forward. What that means for the bond space is a very different story in terms of how high yields will go, how high yields will stay, and what that will do longer term, not only for the Fed action, but in general for companies as the price gets more expensive and as they start to just throw in the towel and raise debt anyway.
Day after Labor Day, up 5 basis points. Standard & Poor's 500 futures up 0.3%. Much going on here on a Tuesday as we plow through the week. I guess it's a quieter economic week after the festivities last week, but nevertheless, a lot of cross currents and stories today. I think we got to go back to the Pacific Rim, and barely mentioned by us today is yen weakness. And over the weekend, I'm sorry, I can't remember who it was, had a real nice inflation pain story in Japan. 3% inflation for the Japanese is a shock.
Well, household spending has been going down as a result. Potentially, that's been one of the connections that people made with some data that came out over the weekend. When you talk about the Pacific Rim, I think coming up later this week, we have the G20 over in New Delhi, over in India, and we aren't going to see Xi Jinping there. And that, to me, is interesting because of what Damien said. In and of itself, who cares, right? But, when it comes to this question of where the allegiance is of India and China, how closely connected they are at a time when China seems to be moving away from the U.S. and Europe, that's interesting to me.
And how the U.S. participates in that dialogue. I mean, I was thinking actually of John Kenneth Galbraith. This is a few years ago. I'm thinking 40, 60 years ago in India. And we have all these legacy thoughts of India in America, most of them ancient and dated and silly. It'll be interesting to get a brief there. And of course, our team in Bombay and New Delhi leading our coverage there of the G20 meeting. This is incredibly well timed. Coming up, David Rubenstein talking to any good number of people for his show, Bloomberg Wealth. David Rubenstein, I want to touch on the caution of Jeremy Grantham. From New York, after Labor Day, this is Bloomberg Surveillance.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
I think the Fed's record on these things is wonderful. It's almost guaranteed to be wrong. They have never called a recession, and particularly not the ones following the Great Bubble.
Jeremy Grantham of GMO, generous in his charity. He's really had an interesting time here with his caution on the stock market and equities as well. An important conversation. Look for this tonight, 9 p.m. Jeremy Grantham of GMO Boston in conversation with David Rubenstein, Bloomberg Wealth, 9 p.m. Tonight. Lisa Bramwitz and Tom King getting your autumn started. The leaves are changing in Central Park. I put out an Emily Bronte poem for John Farrell.
Yeah, I saw that.
The joy of the leaves changing.
Yeah, it was sort of, racked with angst and pain.
You were up north of Tupper Lake this weekend.
Yeah,
I mean, the leaves are already going big time.
Yeah, full time. Like big red trees, and I saw a red leaf fall, and I kind of
burst
teared up.
into tears and all that. Right now, we're going to burst into tears with David Rubenstein. He joins us, of course, of the Carlyle Group. His philanthropy, including completely stacking the Duke football. We have to stop the show after talking to guard Jay Pulaski. Duke 28, Clemson 7. How did you contribute to this win?
I was calling the signals in from the sidelines. People didn't know
with
that.
Your
I had little hand
Duke,
signals, that's what Duke did. If they'd listened to my hand signals earlier, they would have been a better team all along, but they just started listening to them.
Is this Rubenstein making Duke football a new D1 resurgent story?
It's great. We haven't had victory as big as this in quite some time.
What kind of hand signals? Like, woo!
That's how Coach K won all of his championships. I would send in hand signals from the sidelines. He didn't want to tell people that.
Yeah. David Rubenstein, Jeremy Grantham. I know Jeremy for ages. I have a huge respect for him, and his philanthropy speaks volumes. In your conversation with Mr. Grantham, how did you address the 3-year, the 4-year caution he's had on the American financial experiment?
For those who don't know, Jeremy Grantham is a man who is a very distinguished an analyst, financial analyst, and he's been quite prescient in predicting bubbles bursting, and he's really good at that. and he's predicted many bubbles that actually subsequently burst. As a result, he's got a really terrific record as an investor, but now he's spending most of his time investing in climate change and climate tech. He thinks the greatest challenge in the world now is the climate problem we have. So most of his money is in a foundation that goes towards that. But he likes to call bubbles, and he's said maybe artificial intelligence is a mini bubble. But we're now coming out of the tech bubble, and that tech bubble he forecast, and he was not involved in tech, and therefore he did pretty well for his investors. He built GMO many years ago. He's a British citizen initially, but lived in the United States after Harvard Business School. And he built one of the better money management firms in the Boston area. And he's quite well known for his philanthropy, but also for predicting bubbles. And he also says the Fed is almost always wrong in predicting recessions. The Fed is not predicting recession now, but he thinks we will have a recession for sure.
Does he think that it's harder to see a bubble now than in the past? Is it more difficult to spot bubbles in an era where people have been grown up, have been raised through the financial crisis and through the Big Short and all the glory around bubbles?
Well, you don't really know you're in a bubble till it bursts, typically. And he's actually pretty good at predicting bubbles, but nobody's perfect at it. And the reason we have bubbles, he would say, is that there's the phenomenon that everybody is afraid that their neighbor's going to get rich and they're going to miss out on it. So they pile in when things keep going up, and ultimately, in a burst, they're disappointed. Pointed out, for example, Sir Isaac Newton, one of the smartest men ever, he got into an investment, thought it was pretty good, doubled his money, got out, and then he saw it kept going up and up. So he mortgaged his house, took all of his money, put it back in, and he lost everything. He went bankrupt.
Physics and market timing maybe don't go exactly together all the time. I'll just say that.
Right.
But there is this question going forward, especially at a time where people are trying to game out where the Fed is, of just the cross currents and the uncertainties and how much the U.S. can continue to diverge from other places. Does he seem to think that that's overplayed based on the AI bet, that sort of people are not looking at history and that they need to more to really understand this?
Well, I think looking at history would be something he thinks is a good idea, because if you look at history, you'll see that when you have these kind of inflated bubbles, inevitably they're going to burst. And so we've had many bursts. The dot-com bubble is where he really made his name, because he was in effect predicting that would happen in 1998, 1999, and 2000, and his firm did quite well, avoiding the tech bubble that existed then. He's actually a legendarily smart person about predicting follies of the markets, and he's not afraid of telling you that you're not smart, you're stupid, you're doing something wrong. He's not afraid of actually going against the conventional wisdom. Very often people don't want to offend other people by telling them they're not that smart, but he's willing to say, you're wrong about this.
But this is why this conversation is so important, folks. 9 p.m. tonight, Rubenstein, Grantham. David, you're one of the congenital optimists out there. You have put money where mouth is on the artifacts, the heritage of the American financial experiment, the Magna Carta purchase that you made, and the others. I'm not going to say you're the polar opposite of Mr. Grantham, but there's a built-in Rubenstein optimism. Do you maintain that, even with the, not perma-bear, but the perpetual caution that we witnessed with Jeremy Grantham?
Well, he's much more bearish and much more negative on things than I am personality-wise, probably. But, you know, that takes a lot of courage. When you're telling people they're wrong all the time, that's not easy to do. So I'm probably not as good at telling people they're wrong to their face as he is. But he's willing to tell people you're wrong and you're making a big mistake.
All of us rocked by the climate change stories of the summer, this, that, the other thing. What is his prescription to have America address facts of climate change?
Well, he thinks we're not doing enough, for sure. Now, he can't solve all that problem himself, but what he's doing is taking most of his money now and investing it in green tech companies, venture capital kind of companies, small ones, hoping that one thing will come along that will actually make a big difference. But he's not trying to influence our government policy by going down and lobbying. He's past that. But he's actually a very, very clever person who now has made his main focus in life climate tech and investing in things that are going to maybe help with climate.
You've said several times he's not afraid to tell people to their face that they're wrong. Has he said that to you?
Well, he hasn't said to me I'm wrong, but necessarily. But I think generally, when you're predicting people, or you're predicting bubbles are going to burst, you're telling people, 90% of the people, they're wrong. And he's not afraid of telling people they're wrong. You got to have a certain kind of personality. Probably he's better at it than I would be.
The idea of investing in niche companies, sort of what Tom was talking about, whether it's climate change or whether it's some of the venture capital that other people are doing, Is that a more sure bet from your point of view now at a time where there is such a high degree of uncertainty on a macro level?
Well, on climate tech? Or
just in general, broadly, like this sort of niche concept of just going at things very specifically with a smaller pool of money. Is that a sure bet to make bigger returns?
There's no sure bets anywhere, of course. I think the biggest concern that I would have is that we're not quite past the point where we know there's not going to be a recession. I don't think we will have a recession, but nobody knows for certain. You don't know it until you get into it. Right now, the point where we know there's not going to be a recession. I don't think we will have a recession, but nobody knows for certain. You don't know it until you get into it. Right now, the conventional wisdom in Washington is that we've gone past the likelihood of a recession. And there are some people like Jeremy Grantham who thinks that we may have a recession, but it may be next year, not this year. As you know, there was a prediction of a hard landing, maybe by the end of this year, but now most people would say probably not going to have a hard landing by the end of this year. But as the next year, that's when Jeremy Grantham thinks there will be a recession, sometimes next year. And again, predicting recessions is a fool's errand. It's very difficult to do.
Dave, I got time for one more question. It's really important. The quarterback for Duke is just totally irresponsible. He had late homework, and he had to do a whole video asking the professor to delay his, to get his homework in so he get a quality C. Riley Leonard of Duke University. I mean, is he destined for a Carlisle internship? I mean, where are we on this? I need to make some news today. Help me.
Well, I think in college football and college basketball today, you can make more money playing college basketball and college football than going to private equity firms.
What did you think of the Citadel internship? The salaries they're getting? Did you see that last week? They're making ginormous money.
Well, Citadel is a great firm, and it's got a great leader, and they're making a lot of money, and I guess they're paying out a lot of money. They want to get really smart people, and they can pay up for it.
But what was your first internship in finance? Where you walked in the door and said, "I'm just glad. Can I get you?"
I didn't have an internship in finance. I think my first job was probably selling magazines door to door or something like that. But I didn't have a finance internship, really.
David Rubenstein here. Riley Leonard, if you're listening to this morning, call 1-800-RUBENSTEIN and you get that Carlisle internship going. Duke, I mean, it's exciting. It's college football season.
Yeah, it is. And that was quite a game that they delivered. I'm sure they'll be hearing a lot about it in your next hour with Paul Sweeney, who might be very excited.
He will, but Colorado Buffaloes, Ralphie comes out in the field. It's like a real buffalo. Comes out in the field. Deion's going, recruit him. We can have him as a defensive tackle.
Yeah, we could bring him in here.
Buffalo's beat TCU. It's very, very exciting. Tonight, rather this afternoon, I'll get it right. Tonight, this afternoon, actually a really timely conversation. Lawrence Culp, GE Chief Executive Officer, an update there, to say the least. 1:30 this afternoon. This is Bloomberg. Good morning.
With sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects there needs to be an understanding, the user needs to understand the level of data that it's collecting and then be the one who says where that data goes.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
This is Bloomberg.
Let's get back to work. Live from New York City this morning. Good morning, good morning. Your equity market's slightly negative on the S&P 500. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, economic data keeping Chair Powell on the sidelines. Goldman Sachs cutting recession chances to just 15%. And President Biden making his Labor Day pitch. We begin with the big issue. Goodbye, August. Hello, September.
We're heading into September.
A seasonally weak September.
There is a seasonal aspect to September.
The seasonal trends tend to be negative.
September's the worst month of the year. The weakest month of the year.
We could see continued volatility.
We have the return of student loan payments.
That very important Fed meeting.
We're heading into September with very strong positive economic momentum.
We got a nice employment number.
Pretty good report. You're seeing the kind of Goldilocks scenario that the Fed wants.
The Fed that is likely to press the pause button on the rate hiking cycle. That's a pretty good backdrop for risk assets.
The economy in general is on decent footing.
We are on a wait and see.
More patience is warranted.
Kicking off the show with Citigroup's Stuart Kaiser, Jim Bianco of Bianco Research. Jim, great to catch up with you as well, Stuart. Jim, I want to start here on the Federal Reserve. Rate hikes on ice. Is that what they're going to say?
I think so. I think that they're going to probably pause at the September meeting because the market is giving you less than a 10% odds. But the question will become the November meeting because those are a lot closer to 50-50, and we'll have to see how the data plays out from there.
Stu, is that the Citi view as well?
Yeah, Jonathan, good morning. I think the base case is just that. They'll pause in September, but they're going to want to keep November in play, just because they're going to want to respect the fact that they don't know how data is going to come in, and I think they want the market to just not price them as completely done with the cycle. So, yeah, pause in September and keep November kind of on the table just in case.
Bond market yields high this morning, 10-year up by 4 basis points right now, 422. 2-year up by a couple of basis points to about 489 or so. Jim, I'm struggling with the consensus view coming into September in this bond market at the moment. What is that consensus view now?
I think the consensus view is bullish. A lot of people are looking for a recession. They think that the inflation problem has been vanquished. They're looking at the data and they're seeing in the futures market a big short position, but that's probably a basis trade. And once you've taken that out and you look at positioning or you look at economist opinions, they're all kind of looking for rates to fall, and the contrarian play would be a further rate hike, or further rate rise, excuse me.
So sticky inflation, no cuts, stronger growth. Contributing to that, Jim, maybe this headline, just dropping across the Bloomberg. Excusing me for being distracted. Saudi to extend voluntary cuts of 1 million barrels a day until December, the end of December 2023. Looking at the oil market right now, 5-day rally coming into today. Crude with a pop, 89.64, just short of 90 here on Brent crude, up by 0.75%. Jim, a word on crude. Is that a reflection of a better demand backdrop, or is that just the supply story playing out?
Well, I think it's more of a demand story because you got to keep in mind since late June, crude oil prices are up more than 27% right now. Gasoline prices haven't caught up with it, and they probably will. When you see a big move like that, and yes, I know the Saudis have been voluntarily cutting. They've extended their cuts, but those have been in place for months. It's more consistent with a strong Atlanta Fed GDP and strong data and downgrading the probabilities of a recession because people are consuming energy because the economy is moving forward. I think that will continue to be the case. In other words, crude oil and gasoline prices might be a market-based measure of economic demand, and right now they're both very strong.
New highs for the year on crude right now, just short of 90. It's the South rally, Stuart Kaiser, hardly anybody's talking about. What do you make of it?
Look, I think our view here is essentially what Jim described, which is economic data continues to come in strong, and that's pushed cyclical assets, higher and also pushed yields higher. I think the big risk here is, as we've talked about in the past, Jonathan, is that expectations have gotten a little bit more stretched, and the reaction function of equity markets to that data and actually to the rise in yields have become a little bit more troublesome. So, as a base case here, we're still relatively positive on the markets. Strong labor market, easing inflation, but there's definitely some fraying around the edges that I think you need to respect.
Well, Stuart, to build on that, this was a rally so far year to date that has been built on top of upside surprises, economic data coming in better than expectations. Can you make the same argument that we can build a rally on a series of downside surprises?
That would not be our view. Look, we believe equities are a nominal growth asset, and I think if you start to see disappointing economic data, you don't want to step in front of that. You want to let that weakness happen, and you want to buy at a lower level. So I think from my perspective, I agree with you. I think positive economic growth surprises what's driven the market higher this year, and that works in both directions. And if the nominal growth starts to weaken, I don't think that's something that you want to trade to the upside from an equity perspective.
Here's another headline, 2 in the last couple of minutes. If you are just tuning in, let's get up to speed together on the commodity market at the moment. The first headline from the Saudis to extend voluntary cuts of 1 million barrels a day until the end of December 2023. The second headline, this one from Russia, to expend a 300,000 barrel a day oil export cuts through December. They're trying to support the crude market. Jim, I'm going to throw in iron ore as well. So crude at new highs for the year. Iron ore at highs we haven't seen since maybe April. This all happening with a slowdown developing in China. Jim, what's the signal you take from that?
Look, I think when you look at the broad commodity markets as they move higher, especially in the industrial metals where iron ore is and in energy, the takeaway is that the economic strength or the nominal growth in the economy globally is stronger than people think. Yes, China is slowing down, but it seems like the rest of the world, even though we keep talking about recession and slowdown, seems to be compensating for that, and that's why you're seeing higher commodity prices. And if we are seeing higher commodity prices, eventually that should translate into higher yields. Again, as we talked about earlier, at the same time when everybody's positioning themselves for a fall in interest rates.
Well, right now it's fueling higher crude prices through 90 on Brent. Brent crude at $90 a barrel, up by more than 1% on a session. WTI crude just short of 87 here at 86.99. Turns through 87 briefly, up by 1.8%. Jim, let's stay on top of this oil story. Have we seen enough from China? Enough from China, from your perspective, to suggest they can put a floor under this growth risk now?
Not yet. I think that the Chinese have really got problems with their property market, and they've got other issues they have to deal with before we start to say that there's a floor there. Now, maybe it's priced in and their financial markets might bottom, but their economy won't. And let's keep in mind what extraordinarily is happening there. They reopened after zero COVID in January, and yet it might wind up being that this year is the same growth or worse than the year that they were welding people into their houses last year, which is an incredible statement to say on its own. And it underlies the big problems that the Chinese economy has, which is why I don't think I've seen enough to say that they've got a handle on it. And it isn't just that they need a couple of more basis points cut from the central bank in order to spur growth. It's much more structural than that.
Stuart, how does what happens in China shape your view of what happens here?
Look, it definitely matters. I think the narrative around China and the impact on U.S. equities has shifted over the last month. Initially it was China's exporting deflation, and that's going to be positive. It's going to help the Fed. I think that discussion has frankly shifted to something that's more about a negative growth impulse and potential event risk coming out of China. So I think it does create a headwind from a growth perspective. Obviously also impacts European equities, particularly German exporters and luxury good manufacturers. So there's definitely an impact, and I think the narrative around it has shifted much more negative over the course of the last month or so.
It's certainly amazing to see growth in China disappoint, coming much lower than expected in 2023 relative to expectations of 9 months or so ago at the start of this year, and see crude back with a 90 handle on Brent. That's the latest for you this morning. Two headlines, one from Saudi, one from Russia. Saudi Arabia to extend voluntary cuts of 1 million barrels a day until the end of December 2023. Throw in Russia to extend 300 barrels a day oil export cuts through December. And you've got the recipe for a higher oil price right here, through 90 for the first time since November. That is a new high for 2023. Crude right now, Brent up by 1.3%, WTI up by 1.9%. To Jim Bianco's point on the bond market, fueling maybe some upside in yields here. Treasuries down, yields up by 5 basis points on a 10-year 4.22. Levels we've seen through much of this morning, up by 2 basis points on a 2-year, up to about 4.90 on a 2-year yield right now. Jim and Stuart are going to be sticking with us. Let's get you some movers elsewhere, with equity futures still just about negative by 0.1%. Here's Simone Foxman.
Yeah, John, equity futures may be looking negative, but Airbnb shares are rallying after it was announced that it would be included in the S&P 500 index as of September 18th, that along with Blackstone. And this really highlights the importance of passive index funds, because as we speak, the local law 18 in New York City is going into effect, and that severely limits the company's operations, but we see shares still up over 6% in the pre-market. Also watching shares of Nikola, there were local news reports of a semi-truck fire at Arizona lithium facility in Tempe last night. There were no injuries reported, but there have been a lot of concerns about the possibility that there are battery problems that cause fires in Nikola's electric trucks. We're also closely watching Warner Brothers Discovery. We're not seeing a big movement at the moment right now, but we're the company guiding lower adjusted EBITDA for the full year after a $300 to $500 million hit from the impact of these strikes. That despite the fact that Barbie has become the best grossing movie worldwide this year, John.
More from Simone around the opening bell. That opening bell about 20 minutes away. The latest in the oil market, 6-day rally on Brent crude, up another 1% today. Briefly through 90, just about there right now. $90 a barrel for the first time since November, as the Saudis and the Russians keep pulling back. Coming up, President Biden making his Labor Day pitch.
You know, there are a lot of politicians in this country who don't know how to say the word union. They talk about labor, they don't say union. It's union. I'm one of them. I'm proud to say union.
Latest from Anne-Marie, up next.
Crucially important, and I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
He's
story.
there, the kind of upside.
You know, there are a lot of politicians in this country who don't know how to say the word union. They talk about labor, they don't say union. It's union. I'm one of them. I'm proud to say union. I'm proud to be the most pro-union president according to the experts about in American history. And that's and by the way, I make no bones about that.
The president attempted to shore up ties with labor unions in Pennsylvania, downplaying the threat of a potential auto strike, telling reporters, quote, "I don't think it's going to happen." The contentious negotiations leaving an opening for Republican frontrunner Donald Trump.
What's happening to our auto workers is an absolute disgrace and an outrage beyond belief. Both the UAW bosses and the big three auto executives should be screaming at the top of their lungs. They should be ashamed of themselves, demanding that Joe Biden cancel his brutal electric vehicle mandate before it destroys the entire U.S. auto sector. To every auto worker, I stand in total solidarity with you in your fight against Joe Biden's job-killing Green New Deal insanity.
Donald Trump on the offensive as voters overwhelmingly think President Biden is too old to run for re-election and giving him low marks for his handling of the economy, according to a new Wall Street Journal poll out in the last couple of days. Bloomberg's AMH joined us from Washington, D.C. Anne-Marie, who's going to win that battle for those unions?
Well, for the UAW, Jonathan, at the moment, it's still up for grabs in the sense that they have not come out and endorsed anyone. And they've said that people in Washington need to take note about what is going on. If they want our endorsement, they need to be there for us. So that is something you see the former president, Donald Trump, try to tap into. He was out with a Truth Social post yesterday about this, saying there's an EV glut and UAW should not be backing the Biden administration. We should note the UAW did back Biden in the last round. They likely will lean towards the Democrats, but they're probably just using this endorsement as leverage at the moment, the same way they're using a strike as leverage at the moment, as they are up against the three big auto companies. And Jonathan, that contract expires September 14th. And when you heard from President Biden yesterday is that when he said he didn't think there would be a strike, Sean Fain, the UAW president, came out and said he must have more information than we do.
AMH, the president says he's the most pro-union president ever in the history of the United States. I have no idea what that means. Isn't this the most easy time to be the most pro-union president of the United States, given where union membership is relative to where it was decades ago?
That is true. Relative to decades ago, if you look at the 1970s, an organization like UAW had more than 1 million workers. Right now, it's a few 100,000. But at the same time, the president does want to make sure that he is talking about labor unions. He talks about the fact that he's a son of Scranton. This is where he was talking on Labor Day in Pennsylvania. This is something he wants to lead into. His biggest issue, though, Jonathan, is one of the biggest gripes the UAW has is with the electric vehicles. When you see this administration come out and talk about loans or subsidies or grants for companies to build battery plants, the UAW, they do not have kind words for this administration.
His biggest issue this morning is in the oil market. Anne-Marie, let's go there. Two headlines in the last 10 minutes or so. One from Saudi Arabia, one from Russia. The message pretty clear. We're not going to stop pulling back anytime soon. How do you think this White House responds to that?
Well, Jonathan, this kind of goes to their industrial policy of wanting to electrify the grid. They wouldn't have to worry as much about what Saudi Arabia was doing. What we're seeing from the Saudis is that it's prolonged this cut. We didn't think it was going to be this long, and that's why you see Brent prices spiking above $90 a barrel. The administration was already concerned with gasoline prices. They're nowhere near they were last summer when they hit above $5 a gallon, but they are trending towards $4 a gallon. That will be very difficult for this administration that is still dealing with inflation. Yes, the rate of inflation is slowing, but they're still dealing with inflation. This continues to show up in polls, and it's why the Americans give the Biden administration poor marks on the economy.
$90 Brent right now on the screen at 1.5%. AMH, thank you. Anne-Marie with the latest down in Washington, D.C. Some final thoughts from Stuart Kaiser, Jim Bianco. Jim, let's pick up on that crude story. Crude right now at 1.5%. September 20th, the Federal Reserve. We can work backwards. September 13th is CPI. Jim, some upside risk to the inflation story into year-end from your perspective?
Yeah, I think on two levels. On first level is that September of last year was a small number. It was 0.2. We're looking for somewhere between 0.6 and 0.8 for this month. In other words, a base effect that could push year-over-year inflation up to 3.7 or 3.8. And if you extend that through the rest of the year, it really does look like year-over-year inflation bottomed at 3% in June, and it's going to probably start drifting towards 4%. Now, that's not catastrophic, but it's certainly not the type of number that's going to get the Fed to be talking about 4 rate cuts next year if we end the year at 4% inflation.
Stuart, how would you expect equities to trade around that kind of story? If Jim's right, what kind of price action would you be looking for?
Yeah, I mean, our view is pretty similar, is that you probably saw the 2 weakest prints you're going to see this year over the summer, and, potentially, A, some upside risk, and B, you're probably just also going to tick higher relative to those very low numbers. My view here is, as long as inflation volatility remains relatively well contained and you're kind of in a slowly easing or grinding lower type inflation environment, equities should be okay. If you saw something at 0.6, 0.8 and inflation actually hooked higher, obviously the market would have to price that risk a little bit, but big picture, inflation volatility's come down. The rate of inflation has sort of stabilized a bit, and I think, what equity markets want is clarity and certainty. So if you have sort of stable inflation, stable jobs, I think equity markets can handle that pretty well.
Stuart, over the weekend, I was reading through it, you gave a base case, a tactical view, and a contingency plan. Stuart, can you go through that for us now?
Yeah, sure. Our base case, as I mentioned, is, job market remains pretty solid. Inflation is easing, but a little bit sticky. And I think, that allows equity markets to work, probably with, not the type of velocity we saw earlier this year. Tactically, we do like hedging markets. There is the chance here that inflation does tick higher. You're running to the show, mentioned seasonality a few times. So that's obviously a risk in the background. China, higher rates, market technicals, options flows. There's a lot of tactical reasons, I think, to be a little bit careful. And we do like hedging through till the end of the quarter. The contingency, though, I think is the key thing here. It's what could really disrupt this rally. And we've put 3 things out there, but number 1 on that list is U.S. labor markets. And I do think if you see U.S. labor markets continue to start to weaken, meaningfully, then you are going to see equity markets trade lower. Our view is you don't want to step in front of that. You don't want to buy the first sign of weakness. You kind of want to let that weakness play out. So the contingency for the markets here is the strength we saw in the labor market on Friday, doesn't get repeated. Labor market and services sector comes under pressure, and I think that's your bigger downside risk. Hedging-wise, we would focus on U.S. retailers as a way to play that story.
In other words, Stuart, bad news is just bad news.
Always. They wouldn't call it bad otherwise, right? They would call it good if it was good.
Jim, you on the same page?
Yeah, I am. I think that definitely on the page that, bad news might wind up becoming bad news as we move forward from here. But I think that when you look at the labor market, I want to go back to what you and Anne-Marie were talking about. The labor situation, especially among unions, which is only 6% of the labor force, is getting to be very substantial. I think one of the things the UAW is looking at is a 32-hour work week, a 4-day work week. They want to go hybrid like everybody else does, and these are intractable problems. So the labor market could give us quite a bit of volatility as we move forward, unless there is some kind of a deal, and then you've got potentially a transit worker strike in New York City coming right after that for the same reasons.
Sign me up, Jim, not for the strike, but for the 32-hour work week. Now, Jim, you mentioned the union membership and how low it is, particularly relative to where it was several decades ago. You can make the argument that maybe these negotiations are meaningless for the overall labour market. Do you think there's a signal effect here, though, Jim, that we all see those headlines, we get to year end and we say, you know what, I'll have some of that as well?
Oh, yeah, I think it all started with the UPS workers getting $170,000 a year to deliver packages, that is reverberating through not only the West Coast port, but, the UAW and the transit workers and everybody else is saying, I want to get some. And yeah, you're right, 94% of the workforce is not unionized, but that 6% is. If they walk out on strike, like the Hollywood writers' strike, another one, it can be very disruptive for the economy as we go forward.
I'll form a union for the 3 of us, guys. 32-hour work weeks coming up. Jim Bianco, Stuart Kaiser, to the both of you. Thank you, guys. Going into the opening bell, about 7-8 minutes away. Equity futures here on the S&P 500, slightly negative through most of this morning. On the S&P at the moment, we're down by 0.15%. This big move in the commodity market over the last couple of weeks. This is day 6. A 6th day of gains for Brent crude, through 90 for the first time since November. So we have a new high for 2023, $90 and about 60 cents, up by 1.8% off the back of these headlines that Russia, Saudi Arabia are going to keep on pulling back just keep on pulling back. The latest headlines from Saudi to extend the voluntary cut of 1 million barrels a day until the end of December 2023. And right at the same time, Russia to expend the 300,000 barrel a day oil export cuts through the end of the year as well. Crude up this morning by 1.76%. Coming up in the morning calls and later, Goldman Sachs growing more confident about a soft landing in the US. We'll have that conversation with PIMCO's Tiffany Wilding.
Of the large Chinese technology companies, let's say Alibaba, Baidu, Tencent, they have gigantic market values and they're very prominent in China, not as prominent outside of China as obviously in China, and certainly not that prominent in the United States. TikTok, by contrast, is not in China, but it's gigantic outside of China, of the United States and everywhere. What did TikTok do that enabled a Chinese-based company, parent company at least, to do so well outside of China?
We think it's challenging to build a global company in general, but the best ones we have seen so far are ones that take very consistent global learnings and adapt them to the local countries that they are operating in. So you need to be global and local at the same time.
This is where we've been all morning in equities, just a little bit softer on the S&P, down by about 0.1%. That's the price action. Let's get you some morning calls. First up, RBC upgrading American Express to outperform, pointing to manageable credit trends and the company's double-digit revenue growth outlook. The stock is up by 1%. BNP hit downgrading General Mills to neutral, expecting cautious consumers to spend less on premium pet foods. The stock is down by 0.8%. And finally, Bernstein upgrading Lowe's to outperform, seeing a favorable setup with multiple catalysts on the horizon. The stock is up by 0.6%. Coming up on this program, we speak to PIMCO's Tiffany Wilding on what she calls a Goldilocks jobs report. That conversation up next, your opening bell, just around the corner.
I don't think we can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Five seconds away from the opening bell, coming off the back of the best week of gains on the S&P 500 since the middle of June. Futures right now negative by 0.1%. On the Nasdaq, down about 0.2%, with Fed rate hikes seemingly on ice. More data still to come before we get to the 20th. The 13th is your next CPI report. There's your opening bell. Switch to the board and get to the bond market. Yields look like this in the Treasury market right now. Yields higher by 4 basis points. $4.22. Dollar stronger. The euro down to 107.45. We're negative by 0.5%. The lowest, the weakest euro, going back to about June. The rally in the commodity market getting everybody's attention. It is day 6 for Brent crude. It is day 8 for WTI. Brent crude is up by a couple of percentage points and through 90 for the first time going back to November. For WTI, longest winning streak going back to the start of this year. WTI crude, $87 and about 20 cents. We're high here by 2%. That's the cross-asset price action at the moment. We need to look at one thing, ARM, one of the most anticipated stock listings of the year so far, downsizing its IPO and now planning to raise as much as $4.87 billion in what would still be the biggest IPO of 2023. Ed Ludlow has more. Morning, Ed.
Yeah, good morning, Jonathan. According to the Form F1, ARM will offer $95.5 million shares, 955.5 million shares in the form of American Depository Receipts, or ADRs, priced currently in a range of $47 to $51 each. As you said, that would see them raise $4.87 billion. Even at the bottom end of that range, if they price at $47 a share, it would still make this the biggest IPO globally of the year, surpassing Johnson & Johnson's consumer health spin-off of Kenvue. You'll remember that came in raising $4.37 billion. A lot of interest here, partly because we see it as a kind of starting gun for the IPO window for technology companies. There are a number waiting in the wings, as you know. Previously, we believed that ARM wanted to raise between $8 and $10 billion at a much higher valuation, say $60 to $70 billion. But what happened or transpired was SoftBank acquired the 25% stake of ARM that the Vision Fund held. And we know that all told after the transaction, SoftBank will still control 90% of the shares, which is an interesting dynamic given the kind of big name cornerstone or anchor investors that are on this deal, which include Apple, Nvidia, AMD, Alphabet, Intel, among others that Bloomberg's reported, but certainly one that we're watching very closely.
Ed, let's make it really simple. So they're going to raise potentially half of what they hoped to raise only a few weeks ago. In terms of the valuation, it might be in the 50s. They were hoping it would be closer to 70, at least in the 60s. Ed, is that a SoftBank problem or a broader market story?
I think a mechanical problem, you know, it's by virtue of the transaction that SoftBank's done. I think, like, even based on the math that Bloomberg's done, at the top end of the range, $51 a share, it will have a valuation of $54.5 billion. You know, part of the psychology of this whole IPO situation and ARM going first is a lot of names that are waiting in the wings, want to see how it's going. But ARM, like everyone else, and SoftBank, by virtue of holding 90% of the company, wants to leave a little room for upside. That's what I keep hearing from bankers and sources that I speak to in the tech industry. And remember, ARM aside, a lot of these companies went through painful down rounds over the last 18 months, but with the longer term goal of going public and having some potential upside out of that being the motivating factor.
Just set the bar a little bit lower. And thanks for the update.
Exactly,
Thank you, buddy. 3 minutes into the session right now, negative 0.1% on the S&P, pulling back just a touch on the NASDAQ by 0.4. Let's stick with the tech sector. Barclays upgrading Oracle to overweight with a street high price target. The analyst writing this, we see a multi-year opportunity for solid growth at high margins, partly fueled by emerging AI workloads, which will be the key to the overall story. Isabel Lee has more. Hey, Isabel.
Hey, John, and that price target is now one of the highest in the street, from 150 to 150 from 124. And 150 is a 24% increase from Friday's close. Barclays sees scope for strong growth at high margins, and that's supported by Oracle's software as a service and its cloud infrastructure, both of which it said can outweigh lower growth parts of the business. And just last week, UBS also upgraded Oracle to 140. UBS is also citing the cloud infrastructure as well as the GPU capacity of Oracle. AI really seems to be the theme of the year, John, and recall in March, NVIDIA extended its collaboration with Oracle, also in relation with its cloud infrastructure, and as UBS said, the AI story still has a lot of room to play out. Oracle is now up some 50% year-to-date, John.
And up about 0.4% this morning. Isabel, thanks for the update. Thank you. I want to turn to some new names potentially on the S&P 500. Both Blackstone and Airbnb will join the index prior to the opening bell on September 18th, replacing Lincoln National and Newell Brand. Simone Foxman on top of that one. Hey, Simone.
Yeah, this is a long time coming for both of these names, which have multiple share classes. And that was something that wasn't able to be allowed. You couldn't be in the S&P 500 index if you had multiple share classes until the S&P Dow Jones repealed this rule back in April. So just to recap, to qualify, you have to be a highly liquid U.S. firm. You have to have a market cap of at least $14.5 billion, and you have to meet certain metrics of profitability, liquidity, and share float standards. Now, Blackstone will become the first alternative asset manager to ever be included in the S&P 500 index. This despite the fact that it went public back in 2007. But after they dropped the rule, both Airbnb and Blackstone seen as benefiting here. And of course, this despite some unfavorable rules that come into effect for Airbnb today. We can see the impact on the shares, rallying 3%, over 3% for Blackstone, over 7% for Airbnb. John.
Simone, thank you. 5 or 6 minutes into the session, your update right now, negative 0.2% on the S&P. No drama there. On the NASDAQ, down by 0.4. Now, I'm not sure what would make you more miserable, being a Manchester United fan over the weekend or holding the stock this morning. I'm looking at my floor manager right now, who is a Manchester United fan. Stick with me. The stock is down by about 11.4%, 5 minutes into the session, as Man United may be taken off the market after the Daily Mail reported that the Glazer family isn't getting offers matching their asking price, writing, quote, "The Glazers are thick-skinned and won't be influenced by any negative fan reactions." Katie has more. Hey, Katie.
Hey, John. Yeah, you take a look at shares this morning, currently off by 11.5% after the report in the Daily Mail over the weekend. According to sources, the Glazer family, that thick-skinned family, they originally hoped to attract multiple serious bidders here, but only ended up with two. We're talking about Sheikh Jassim of Qatar and Jim Ratcliffe. Now, the Glazer family reportedly taking the team off the market. They're going to try again in 2025 when hopefully improved conditions will attract more bidders. And the Glazer family is looking to sell the team for between 7 to 10 billion euros at that time. Again, according to Daily Mail sources, as of Friday's close, you look at the market, Manchester United valued at $3.9 billion or about 3.6 billion euro. Now, it's worth noting here that when contacted by Bloomberg, a team spokesperson declined to comment on, quote, rumors and speculation. But even still, you can see the drama playing out in the stock market. Shares now off by 11.7%. If that holds, John, it'll be the worst day since February.
Did they comment on the Arsenal game? Katie, that's what we all want to know.
I barely know what we're talking about here, John, but I'm not sure.
We appreciate your honesty. Katie, thank you. On top of the stock, more than the game over the weekend. Would you like to talk about? No, don't want to talk about the Arsenal. No? Okay. Goldman Sachs cutting its US recession odds down to 15% from 20, writing this. Real disposable income looks set to reaccelerate next year on the back of continued solid job growth and rising real wages. We still strongly disagree with the notion that the long and variable lags of monetary policy will push this economy towards recession. PIMCO's Tiffany Wilding offering her own assessment after Friday's payrolls data, writing the following. This was a Goldilocks report for the Fed. Labour markets are cooling but not falling off a cliff, and the slowing is likely to continue as the economy faces various headwinds in the second half of 2023. I'm pleased to say that PIMCO's Tiffany Wilding joins us now for more. Tiffany, let's start there. The kind of slowing that you're expecting into year end for some really phenomenal numbers we're seeing in the third quarter.
Yeah, well, certainly consumption has been the standout this year. The consumer's been very strong, and that's pretty aberrant from historical hiking cycles. You do tend to see more moderation in consumption as labor markets slow. We're just really not seeing that. Consumption in the third quarter looks like it's running above 2.5. Obviously, GDP tracking reports also look like they're closer to 3. So this is an economy that just doesn't seem to want to quit. Now, nevertheless, though, we are seeing indicators, higher frequency indicators that would suggest that things are slowing. So we have student loan repayments that are starting. Treasury daily data suggests that people are actually prepaying that, and at the same time they're spending less. So high frequency data from credit cards suggests that we are seeing consumers that are starting to pull back. Add to that, that you have seen much less credit creation overall for the economy this year, and that is a recipe for slowing. Now whether it actually pulls us into a recession or not, I think that's more of a question mark here, just because of the ongoing resilience in the U.S. economy.
Well, do you see us on a path towards returning inflation to 2%? Are you confident we're on that path, Tiffany?
Yeah, well, we're certainly going to get some good news on the inflation front in the back half of this year. But really, that good news is centered around some of the pandemic-related effects just fading. Of course, things in China have been much weaker than expected. They are, as a result, exporting some disinflation. That's going to help U.S. retail goods prices going into the holiday season, which many consumers will be happy about. But nevertheless, other measures of inflation, wages, for example, in the United States, they still look sticky. The super core measure that the Fed loves, services ex shelter within the PCE inflation measure, also still looks relatively elevated. So one of the things that we've been noting, and this is consistent with the Fed's forecast, is that you do need to see some labor market cooling in order to get that down. And I think it's a question on whether we'll see some labor market cooling just because the economy's been so strong.
That's the labor market, throw in housing as well. Tiffany, we could look at commodities too. Can I just get a comment, Tiffany, potentially from you on whether this commodity market move complicates the Fed's effort with Brent, WTI back in and around $90 a barrel?
Yeah, well, certainly, headline inflation matters. It matters for how consumers think about future inflation and inflation expectations. But on the other side of that, it also matters because higher gas prices will affect consumers' ability to spend on other discretionary items. So it's a little bit of a mixed bag in terms of how it affects the economy. We still, in terms of the underlying inflationary pressures, we like to look at core inflation. And again, that's going to look a lot better in the second half of this year, with some risk, though, that maybe it re-accelerates if the economy doesn't cool.
So, Tiffany, when we get forecasts next up from the Federal Reserve, how do you think they'll compare to the last set of forecasts we got earlier this summer?
Yeah, so they're going to be a bit of a mixed bag in terms of their implications for the rate path. So we do think Federal Reserve officials will have to revise down their core PCE inflation forecast, at least for the end of this year. But at the same time, they're probably going to be revising up their growth forecasts. And there's been some good news on the labor market front. They could have to revise down their unemployment rate forecast. So all of that, sort of suggests, maybe they keep that rate hike in the back half of this year. Maybe they don't. But this is coming up in September. We would also argue there's a lot more data between now and the end of this year for them to think about. And I guess overall, just looking out to 2024, if the economy is not cooling, if we are still running at above trend growth, if the labor market, the unemployment rate is still at these levels, kind of 3.5 to 3.8, it's possible the Fed might even have to do more. So I think that's something that that we're grappling with, not our base case certainly, but something that's the risk that's out there.
Well, let's take it one step further. Let's play what if for 2024. Tiffany, are you still of the opinion that, let's say inflation is 2 point something, that they won't be willing to do anything about it? They won't be willing to crush the economy or the labor market. They'll just tolerate 2 point something.
Yeah, certainly. I mean, I think if it's a 2 handle, that's probably good for the Fed. But I do think there's questions around if the labor market remains this tight. It could stay around 3, which is a little bit more cuspy. Yeah, but overall, I mean, I think there is a question around if you get it down to 2.5, let's say, and you continue to forecast it moving lower over the next few years, then maybe that is all you need to do. And that would be very similar to what the Fed did in the 90s with their opportunistic disinflationary strategy. And I would say if you look at economic performance in the 90s, it was pretty good. And overall, 2 is really not. It's not a magic number, if you will. I mean, it's 2% inflation. That there's not a lot of cost benefit analysis around 2 versus 3 versus price stability in terms of their target. Nevertheless, though, as Chair Powell said, they're probably not going to change their inflation target, but they could alter their strategy within that target, to let it go a little bit above for a period of time.
Tiffany, thanks for the update. As always, one of the best. Tiffany Wilding there at a PIMCO on the look ahead for 2023 and 2024 as well. This just in from Anne-Marie. AMH wants you all to know that Manu goal was offside over the weekend, for whatever that's worth. 14 minutes into the session, your equity market slightly negative on the S&P. Coming up, China's big breakthrough.
China has been catching up over the past several years, pouring lots and lots of state subsidies into its industry. So the second prong of the strategy, holding China back, has taken on more prominence in recent years.
AMH and Ed Ludlow, your team coverage up next.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
So many people say the only way to really deal with climate change is kind of eliminate oil and gas and then have more clean energy. Is it realistic to eliminate oil and gas in the foreseeable future?
You actually have to at least mitigate it. I think you have to bring a lot of it down and replace a lot of it, but you also have to. You can also have a huge impact by trying to do things like carbon capture and so forth, right, and around it. And it's going to take both approaches. Even today, greater than 80+% of the way the world operates around energy right now is still fossil fuels, when you kind of look at it. And probably what's more striking is the fact that the demand for it is going up every year.
Things like solar or wind, it's nice and environmentally friendly, but really it's not going to produce enough energy to really replace oil and gas in my lifetime, I assume, right?
Well, not by itself. So let me just say, solar and wind are critical components. This is going to be sort of a collective effort with a lot of different technologies that are each going to come in and take their piece. What we do at Breakthrough, we look at technologies that could produce remove half a gigaton of carbon a year. And the way to think about that number is we have to remove, say, 100 half a gigatons, a year in terms of what we have to replace.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
catching up over the past several years, pouring lots and lots of state subsidies into its industry. And that's why the US, Japan, and the Netherlands in particular have tightened up their export controls on chip-making tools, which now can no longer be transferred to China to help China produce cutting-edge chips. And so this second prong of the strategy, holding China back, has taken on more prominence in recent years.
Chris Miller there of Tufts University weighing in on China's chip race as the US-China tech war heats up. A major breakthrough in the last week, a teardown of Huawei's newest smartphone, revealing an advanced 7-nanometer processor, a sign Beijing is making progress in a nationwide push to circumvent US sanctions. Your team coverage starts right now with Bloomberg's Anne-Marie and Ed Ludlow. Ed, just how big of a breakthrough was this for China?
Well, in layman's terms, this is the best ever made in China chip. That's the easiest way to understand it. 7-nanometer nodes are, for China, where they're at in chip manufacturing. You'll remember on the show a week ago, Jonathan, there were local media reports and speculation that the processor in the Mate 60 Pro might be 5-nanometer. And that was very surprising because broadly the industry does not think China has got to that stage. What the teardown that you're looking at right now, and actually any second you will see the processor known as the Kirin 9000S processor confirms, is that it is 7-nanometer. That is 2 generations removed from the cutting edge, which is 3-nanometer. But what's so important is that Semiconductor Manufacturing International, when you're looking at the Kirin right now, that is the processor. But what is so important about Semiconductor Manufacturing International, or SMIC as it's known, it's China's leading chip maker, but the US technology curbs apply to their supply chain. So we asked the Commerce Department, hey, this 7-nanometer, is it bound by the existing curbs? And they haven't responded. It's fascinating.
Interesting. AMH, if this is a massive win for China, how big a loss is it for this White House?
Well, Jonathan, just look at the timing of all of this. This Huawei new phone came out at the same time as you had Gina Raimondo leaving China. She was there to try to put some more formal engagement in the dialogue between Washington and Beijing that really has deteriorated in the last few years. And now a big question, I think, facing this administration is that are these sanctions, these export controls to try to stem China away from that high advanced U.S. technology, are they effective? Are they adequate? That is something this administration will be asking. But it was a triumphant in China when you have the Global Daily Times putting out a political cartoon where Huawei is seen as a vehicle, car in the road, busting through a blockade, trying to stop cars from coming in and saying that they are basically free from these U.S. sanctions controls and export controls. So this topic is certainly not going to be going anywhere anytime soon, but I would say it's up to the viewers to decide whether or not they thought it was a coincidence that this phone was released as the Commerce Secretary, the agency that is in charge of these sanctions, she was on her way out.
Well, AMH, I'd go one step further. The unveiling was so quiet, and it came at a time when they had someone from the outside preaching to them about why their economy may well be, quote, uninvestable. Isn't that somewhat embarrassing now for the Commerce Secretary to be preaching things like that at a time when they've been able to unveil something like this?
Well, what the Commerce Secretary was talking about is what U.S. companies are saying about China. What we've seen in China, and Reuters reported this weekend about their fund, they're putting another $40 billion into it so that they have their own domestic production of these chips to make sure that they still are remaining competitive with the United States.
Quite a breakthrough in the last week. Ed Ludlow, AMH, thank you to the both of you. About 22 minutes into the session, we look like this. We're down by 0.36% on the S&P. On the NASDAQ, we're down by 0.38. No drama. Let's get you some sector price action. Here's Simone Foxman.
Yeah, just about every sector in the red this morning, with the exception of energy. Industrials, the weakest today, led by losses in part in airlines. Airlines have had a terrible August, down 9.5% last month. Transportation companies as well feeling the pain. But September tends to be the weakest month of the year over the past 30 years, seen an average change of down 0.7% in the month, so not setting us up well. We are looking at communication services trying to eke out some gains there. Where we are seeing some upside is the energy sector. Saudis prolonging voluntary oil production cuts for 3 months. It was anticipated that they would prolong these cuts, but 3 months is quite a long time. Russia joining in, and we're seeing the benefit to the major international energy companies, Exxon, ConocoPhillips, even Chevron, which is dealing with some labor concerns in Australia around potential strikes, up now more than 1% in today's trading. John?
Simone, thank you. If you are just tuning in, that has been the news the last hour or so, the last 50 minutes, the developments with Saudi Arabia and Russia. That move on Brent crude up by 1.3%, $90 a barrel for the first time since November. On WTI crude, about 87, up by 1.9% this morning. That's the crude action. Coming up, your trading diary.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 minutes into the session, starting the week a little bit lower, soft and negative, down by, let's call it a third of 1% on the S&P 500. Underperformance on the Russell, the small caps down here by 1.8%. That's equities. Let's take a look at bonds. The bond market right now shaping up as follows. 2-year, 10-year, 30-year. Yields creeping higher off the back of another rally in crude this morning. We're up by 6 basis points on a 10-year, back to about 424 on a 30-year, further out along the curve, up by 7 basis points to about 436, which incidentally was the high of the year for the 10-year yield in the last couple of weeks. That's the price action. Let's get to the trading diary. The week ahead looks like this. U.S. factory orders and durable goods coming at the top of the hour. The Fed releasing the beige book on Wednesday, plus Fed speak, Collins, Logan, followed by Williams, Bostic, and Harker on Thursday. Another round of jobless claims on Thursday as well. And we round out the week, all coming ahead of the G20 summit, kicking off on Saturday. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
crucially important. And I think we've moved from this attitude from it's an indulgence, a waste of time, almost an illness that needs a cure.
For something as universally important to human life as sleep, mysteries surrounding its necessity and utility have only just been recently uncovered.
Some of our biggest discoveries were in the 1970s or 1980s, and so it makes it a really exciting field because it seems as though we're uncovering new insights each and every day.
Some scientists are going further to find out how sleep and what happens there can be harnessed to further expand our understanding.
It's easy to memorize things. That makes you smart if you can spit back a lot of facts. But if you want to be wise, if you really want wisdom, you got to know when and how and why to use that information. And that's what your brain figures out while you're sleeping.
And the markets are on the move.
The focus, of course, is on Ukraine.
The market is so hyped up about AI.
Unless we see dramatic changes, it's just going to keep getting hotter.
The Fed, the market analysis. We're going to go get straight to some breaking news. We'll have a full roundup.
Going through some of the numbers and what investors should make of them.
We have so many important conversations. Let's check in what you need to know.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to check in with Nathan Dean. He's a senior policy analyst, government policy analyst down in Washington, D.C. for Bloomberg Intelligence. We got Congress coming back, so we need to figure out what they're going to do. Are they going to shut down the government? That would not be good. So we'll check in with Nathan on all things Washington, D.C. And then Eddie Vanderwalt, he's Markets Live editor at Bloomberg News. He's going to join us to talk about the slowing services sector in China. Some very concerning economic news has been coming out of China for the last several months. We'll get the latest there. Then Ted Oakley, he's a founder and managing partner at Oxbow Advisors. Get his market call here as we all come back from summer vacation, get back to work. Let's kick things off right now with John Tucker. He's always here at work.
Yeah, good to be back, except I'm not back. I never left. Only one of the 11 major industry groups in the S&P 500 is higher right now. That belongs to energy as oil prices push higher. Brent crude topping $90 a barrel. This comes after Saudi Arabia and Russia extend their production cut. Meantime, as far as equities, Steve Chivarone, portfolio manager at Federated Global, says the rally in stocks does have legs.
You have a Fed that was hiking. They're either on pause or close to pause. Markets rip when Feds pause. In fact, each of the last times that the Fed has been on pause, you've seen an S&P hit a new all-time high. And I think that's the path of least resistance this time around.
And you did have some Fed speak this morning. Federal Reserve Governor Chris Waller saying there's nothing that is saying we need to do anything imminent anytime soon. Right now, the S&P 500, 16 points lower. That's down 0.4% at 44.99. The Dow Jones Industrial Average, 53 points lower. That's down 0.2%. The NASDAQ 100, 60 points lower. That's down 0.4%. Two-year yield, 4 basis points higher, 492 right now. The 10-year is up 7 basis points. That is at 424. That also giving a lift to the U.S. dollar. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Matt, welcome back. And Paul.
It's great to be here. Thanks so much. I really missed you guys. I was extra excited to come in today because I heard about Duke, and I knew Paul would be in an awesome mood.
All fired up there. Did not see that coming, but they looked pretty awesome. So kind of resetting the expectations for Duke football and maybe just for the ACC in general.
I have to admit, I didn't know Duke had a football team.
Thank you very little. And then how about almost as big was...
You know them ever basketball, right? And unfortunately, lacrosse.
Yes.
Of course.
Yeah. We're all, Duke's solid across the board. Colorado, huge win for Coach Prime going down to TCU and beating them 17th ranked. That was huge as well. But then Duke trumped them Monday night in primetime. So how about that? All right, Matt Miller, Paul Sweeney live here in the Bloomberg Interactive Broker Studio. We're also streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio. Kind of red on the screen today. Not the way to start the week, but here we go. Emily Gaffreo, she joins us. She covers all the equities for Bloomberg News, and she joins us live here in our Bloomberg Interactive Broker Studio. Emily, what are you looking at today?
Well, the S&P 500 is going to get 2 new members. They're not in the index yet, but they were just announced on Friday. Airbnb and Blackstone will both...
Airbnb is going in?
Yes. What? And that was a little bit of a surprise. There were more equity analysts speculating that Blackstone would be added, and that had been going on for a few months, but I didn't see a lot of chatter about Airbnb. So Airbnb is up 7% today, and there's actually an article on the Bloomberg terminal that doesn't seem very bullish for Airbnb. Thousands of the rentals of Airbnbs in New York City may be suddenly taken off the market because new rules are going to into effect that restrict the occupancy regulations in New York City, but there's a backlog in the New York City offices for processing these.
No surprise.
So according to Bloomberg, the city has only processed 25% of the 3,250 applications.
So do you know anybody who's used an Airbnb in New York City?
Oh yeah, I've used one.
Yeah, my mother has.
Mm-hmm.
So it's just somebody's apartment. I mean, I look on 57th Street, where they got the Billionaires Row, and those huge buildings are all completely empty. But
right, where Tom lives.
They're not probably B&B. But
where Tom lives, right
exactly.
over Central Park South.
Exactly.
Yeah, no, I think a lot of people use these options. My mom used to always come and stay at the Williams Club.
Right.
Because she was a Wesleyan grad. I guess it's like a 3. What do you call them? The little 3.
Yeah,
They accept everybody. But now she's staying at Airbnbs when she comes into town. Also, I don't really think regulations matter in New York City. Does anyone care what the regulations are?
So this is from Bloomberg. At stake is potentially millions of dollars in lost revenue for Airbnb. Some 7,500 units don't meet the requirements to
But no one
apply
follows
for a
the rules
license.
in this city.
But I guess these Airbnb rentals will.
Yeah. In this
more
city,
than half of the listings.
You want a soda, you walk into Rite Aid, you just grab one and leave, right? It doesn't matter in this city.
Maybe that's why the stock is up 7% today, because people realize it doesn't really matter.
Now, Blackstone blew me away. I didn't know that it was as big as it is. It's like 100. I'm pulling up the quote right now. But it's huge market cap, $130 billion in market cap.
Right.
I didn't know it was so big. But
that
that's
was one of the
S&P.
reasons why I think for a while people were a little confused why it wasn't in the S&P 500.
Yep.
There were some rules around the multiple share classes that Blackstone had, but then the rules were changed, and so now it's in that index, and it's the first alternative asset manager to be in the gauge.
All right, what else you got for us here? Because I'm looking up Rich Go, just because when I saw Blackstone, I think Schwartzman, and I want to see what his worth is right now. So I'll get back to you on that.
We also have Oracle higher. Barclays upgraded to overweight from equal weight in a note. They called the infrastructure software company a multi-year growth story. And I'm also just thinking about the rest of the year in equities and how this is going to go. I just did an interview with the head of strategic asset allocation at Fidelity International.
Nice.
While everyone else is scrapping their recession calls, he actually is doubling down.
Really?
He's adding cash to the portfolio recommendations over at Fidelity International because he explained that the debt refinancing that's going to happen at the end of this year into 2024 and into 2025, it's going to start to crush profits for a lot of these companies because they locked in low rates. Now the debt is becoming due, and they're going to have to refinance at a much higher
It's difficult
rate.
for the Miller Real Estate Trust.
Oh, I'm sure it is.
You know,
because you're going back to your bank
back
in
to
Ohio.
Columbus. Yeah,
and
we got to refi stuff.
Yeah, that's going to hurt. Just for the people on the Rich Go hunt, Steven Schwartzman ranked 39th in terms of global wealth, $35.3 billion. So good for him. And Blackstone. So you go back to the bank, and it's not 2, 3, 4%.
It's harder. I mean, it depends on the property that you're refinancing, right? Fortunately, medical offices are good.
Yep.
College dorms are good, or college kid apartments, more like. But other commercial, difficult.
Yeah, but
movie theaters, tough.
Yeah. Are you in the movie theater business?
We have a movie theater. Yeah.
Do you? Well, but you're the Miller family of Columbus. You've got relationships with your bankers.
Yes, of Bexley, Ohio.
Bexley.
And Granville.
Well, I'm from Granville. That's right. And
I
Emily
was just
has
with my cousin from Granville.
some relatives in
over the
Granville.
weekend.
Okay.
Go Blue, Aces.
The Granville Aces?
Yeah.
Nice. Football, big in football in Granville?
I mean, I don't know how many 100 kids go to Granville High School, but, you know, it's huge.
Are you the proud graduate of Granville? And then we'll
I
off the
was
Granville
a
thing.
proud dropout of Granville High School.
John
I was
Tucker?
kicked out of
Does
the
that
Welch Hill
surprise you?
School, kicked out of the Columbus Academy, then finally kicked out of... No, I dropped out of Granville High School voluntarily. They didn't kick me out. They can't show me the door.
You decided you were going
And
to.
here he
Always
is
in my junior year.
at Bloomberg Television and Radio, bringing it to you. All right, very good. Emily, appreciate it. Emily Grafeo, she covers all the equities for Bloomberg News, bringing us the latest here on a market that's a little bit red here on the screen. We're not going to get too tied up about that. Let's head down to Washington, D.C. Nathan Dean, it's his task to follow and analyze all the shenanigans coming from our good friends in the halls of Congress. He's a senior analyst for U.S. government for Bloomberg Intelligence. So, Nathan, you're joining us by Zoom. We appreciate that. My question is this government going to be able to fund itself? Or are we going to get a shutdown at the end of this month? Can you give us a timeline and kind of where we are here?
Yeah, so, the government's only back for, 8 to 10 days, working days until this deadline of September 30th. And like you said, it's highly likely that we're going to end up with a government shutdown. Now, whether this is a 30-day shutdown like we saw under President Trump's administration, probably not be the case. Speaker McCarthy says that he wants to kick the can to early December to give more time over negotiations. But the note that we just put out on the terminal this morning essentially states that if you do have a shutdown, both markets and defense contractors shouldn't be all that concerned. During that 30-day shutdown under President Trump, the markets didn't react all that well in the first couple of days, but then once people realized the economic impact isn't all that great, markets pretty much just moved beyond. Same thing with defense contractors. If you're Boeing or Raytheon and so forth like that, your contracts are already funded in. They're funded in on a long-term basis. So the real big impact for a government shutdown, if it lasts more than a week or two, is that folks like me in Washington, D.C. can't take their kids to the zoo.
Well, what about federal employees? Will they still get paychecks every 2 weeks or however that works? I mean, if you work at the Bureau of Labor and Statistics, putting together the CPI, for example, are you still going to get paid?
So what they do is they deem employees to be essential and non-essential. If you're an essential employee, that's about 15% of the U.S. workforce. Obviously,
that's great. Only 15% of the people that we employ are essential. Everybody else we could do without.
Exactly. So, but what's happened in the past is when the shutdown is over, the Congress will actually pass a resolution or pass a bill that provides retroactive back pay. So if you're shut down for a couple of weeks, obviously that's not going to be good if you're living paycheck to paycheck, but you will get that pay back. That is not the case for smaller contractors. So if you work for a contracting agency and your agency decides to shut down, all of a sudden, you're not going to get that pay back unless the contractor itself pays you back. You're not going to get any recourse from the government. I should also note that, even though I took light of the situation with the zoo, certain things like economic releases, BLS, so forth like that, those eventually could be delayed, which and then also could cause some, confusion and disruption to the traders that are relying on that information.
Well, what about these things you guys down in Washington, D.C. call continuing resolutions or CR? Can't we use one of those thingamajigs?
Yeah, absolutely. And that's what I think is going to happen here. You know, the appropriations process is a 12-bill process, and they've only got an agreement on one. They have to pass 11 essentially in the next month. So what they're going to do is they're going to hit this continuing resolution. The challenge is that Speaker McCarthy has had several people in the House Freedom Caucus just say, look, I'm not going to vote for any continuing resolution unless you defund the FBI or you, implement any of these policies that has no chance whatsoever with President Biden in the Senate under Democratic control. So what's going to happen here is Speaker McCarthy's in a hard place. He's got to figure out a way to pass a continuing resolution, probably to early December, maybe next year, but probably early December, using Democratic support. And that's just something that he's not going to be able to get to until the last moment. So you're looking at either a shutdown will occur, I'm guessing less than 5 days. But, negotiations are going to go way up to the wire, and you're going to see constant headlines over the next 2 to 3 weeks of shutdown angst, and more shutdown angst.
It's just kooky to me how much the far right and the far left have in common. Yeah, exactly. The lefties wanted to defund the police, and now the Freedom Caucus wants to defund the FBI.
Exactly.
I mean, do we not need law enforcement in this country?
I thought the FBI were the good guys. All right, what else besides the shutdown is Congress focused on here? They're going to actually work for a solid 8 days. Good for them. But what else do they have to get done here?
So, you're going to see a lot of negotiations, or at least, we've heard the House Financial Services Chairman, Patrick McHenry, say that he wants to try and schedule a vote on crypto legislation. I'm not sure many of that's going to get there in September. I mean, you have to reauthorize the FAA. The Farm Bill expiration is also on September 30th. So for the rest of the month, you're going to see a lot of people try things, but it's going to be focused on this government shutdown. Now, one thing that came out last week that was interesting is that Bloomberg News reported that the Department of Health and Human Services is going to recommend changing marijuana from Schedule 1 to Schedule 3.
Now we're talking.
That is a big deal for the marijuana industry. And so we're going to be looking to see what steps come from the DEA. They are the ones that are going to have to make this decision. And really, we're looking to see if they get this done in 2024, or is this going to be a multi-year process? That's really key for the marijuana stocks.
Schedule 1 drugs include like heroin and fentanyl.
And that's where marijuana is?
And that's where they have had weed for decades now, because, item 9. All right, so that's something that's probably not going to happen. Salt, any movement on salt at all, Nathan? I got to always ask you the state and local tax deduction question.
Yeah, I hit my phone always before these hits to see what's going to happen with the salt folks around town. But this is laying the groundwork. Look, the salt deduction is going to expire when the Trump tax cuts expire. That's not going to be, or that's actually coming up fairly soon. But this is one of those situations where you have lawmakers from New York and New Jersey going out there and saying, look, we're going to fight tooth and nail to try and get salt back. I mean, they're even saying we would just love to take a pinch of salt. But ultimately, what's going to happen here is if you're going to, the salt deduction brought a lot of money back to the government, or getting rid of the salt deduction brought a lot of money back to the government. That is money that can be used elsewhere. And there are a lot of lawmakers like, ooh, we like this New York, New Jersey money. We can use this for something else. So I think the New York and New Jersey lawmakers, the Salt Caucus, if you will, are just planting the seeds so that when these negotiations come back closer to the expiration date, they can fight tooth and nail at that point to get some relief back to the homeowners of the New York City area.
Right. Is this yet another issue on which AOC and Marjorie Taylor Greene are in agreement?
This is going to be one of those issues where it's essentially New York, New Jersey, California, and Illinois against the world.
Against everybody. All right. I understand we've got some generals and some admirals that need to be approved for senior leadership positions. I thought this stuff just gets done like rubber stamp. What's going on?
So this is coming out of Alabama. This is Senator Tuberville, coach, of Auburn. He's actually holding up these promotions in response to a federal policy related to abortion. And this is a classic standoff between the White House and one senator. And so, we've seen statements from Bloomberg News, their interviews with other Republican senators. They wish that Senator Tuberville wasn't doing this. But this is just a standoff that's going to continue. And, we've seen other statements from both the Department of Defense and so forth that, American security could be harmed. But I don't think we've seen any end in sight. Both sides are pretty dug in. And so this is just one of those cases where I'm not exactly sure if there's a resolution anytime soon.
I mean, poor Nathan Dean's got to analyze and focus on Congress, like, for a living.
Yeah,
That is
and a lot of
brutal.
other stuff, right?
Yeah,
I mean,
he's got
the
all that Washington, D.C.
the weed decision doesn't come from Congress. That's first going to come from who's the weed decision come from? If they push it back to Schedule 3, DEA, right?
The DEA, yeah.
All right, he's got to watch all those agencies. He's got to be careful. You know, the FBI might be defunded.
Yep, exactly. Who knows? All right, Nathan, you got to deal with this stuff. We appreciate it. You're the man. Nathan Dean, Senior Policy Analyst. He covers all the U.S. government stuff for Bloomberg Intelligence. He is our go-to person for all, kind of how the sausage is made down there with all the legislation, the rules, the appointments, all that kind of stuff. And I guess, as Nathan was saying, that the real big order of business right now is, I guess, funding this government. You don't want to see any kind of shutdown, but that is certainly in the cards here. So we'll keep on top of that. Nathan Dean down in Washington, D.C. Looking at these markets here, a little bit of red on the screen. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thank you, Paul. Elon Musk is blaming the Anti-Defamation League for the slump in X Corp's social media advertising. Bloomberg's Ed Baxter has that story.
Ad sales are still down 60%. Musk posting primarily due to pressure on advertisers mounted by ADL. He, in a series of posts, says it has been, quote, trying to kill the platform since he bought it, falsely accusing it and him of being anti-Semitic. Musk says it is a pro-free speech platform, but against anti-Semitism of any kind. He says he is as well.
Now, Musk even threatened legal action. Meanwhile, Musk's Tesla may have some new competition. More from Bloomberg's Gina Cervetti.
Mercedes-Benz has taken the wraps off an electric vehicle with a longer range than any Tesla model on the market. The company presented a near-production concept of its CLA sedan, rated to go more than 466 miles on a charge, beating Tesla's refreshed Model 3.
And shares of Mercedes-Benz right now down just a fraction. Tesla shares up about 3%. And Amazon's been rethinking plans to open Amazon Fresh grocery stores, taking a close look at its strategy, and that's leading to some legal battles. Business Insider says the company is ready to go to court in one case in New York this month after signing a lease last year, but putting nothing there. It's also being sued in New Jersey, Pennsylvania, and Seattle for that same reason. Amazon has tried to get out of leases for about half a dozen fresh stores in other areas. Shares of Amazon right now, they're down about 1.5%. Those are the company stories we're following this hour. I'm Lisa Mateo, and this is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash, being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. Risk sentiment, that is under pressure today. We have higher yields, higher oil prices after Saudi Arabia today extended supply cutbacks. In the S&P 500, only 2 of the 11 major industry groups are higher right now. That's energy and just barely consumer staples. The biggest drag, that's coming from the industrials, and that's where you're going to find the freight transportation stocks. It's kind of obvious. They're going to suffer with higher fuel prices. Goldman Sachs now sees a 15% chance the U.S. will slide into recession. That's actually better, down from their original 20%. The S&P 500 right now, 12 points lower. That's down 0.3%. At 45.02, the Dow Jones Industrial Average, 71 points lower, at 0.2% lower. And the NASDAQ 100 right now down 23 points. That's down about 0.2%. Just to update you on oil, well, look at that. Brent crude back under $90, $89.99 a barrel. NYMEX crude, that's West Texas, up $1.36, 86.91. Was it like 364 at the Wawa?
No, on Route 36 in Jersey. Okay.
For regular.
Yeah, well,
I just want to point that out because
your premium.
What percentage?
Well, no, a lot of people. That's a great question, Paul. I don't know how many, but
I will Google that.
A lot of people have, for example, Paul, your car most likely when you open the little gas door says use no less than 91 octane.
Right.
So, I mean, it's your decision as to whether or not you follow that advice.
Yeah, I have not.
You don't.
Yeah.
But a lot of people do. And so I've always looked at 3AGREG, you know, the ticker for regular unleaded on the terminal. But then I realized fairly recently that, you know, I always tank premium because I feel like I'm supposed to.
You are.
That's 91 is premium at most stations, but you go to Sunoco because they're 93 octane, right?
Well, I go to Shell because I fall victim to the Formula One marketing, the Ferrari marketing of Shell.
You are the only one, I'm sure, that falls to that marketing. All right, John Tucker, thank you so much. We appreciate it. Let's talk global economics here. We're going to go from China. We might head over to Europe. Who knows where else we'll go. Eddie Vanderwalt, he can go anywhere. He is a deputy managing editor of Markets Live team from Bloomberg News.
I want to ask him about Bitcoin first.
Go.
So Eddie is an expert on crypto as well. And Eddie, you know, I was off last week, but I still read the news. And I thought it was so exciting for crypto when we found the Grayscale SEC decision overturned by an appeals court. So I thought, man, this is great news. Spot Bitcoin ETFs are happening. I'm sure that the underlying asset is surging. I come back in this morning to see it under 26,000. What gives?
Bitcoin really is struggling, and it's really fascinating to see this happen, right? Because not only did you have that, you're also coming towards the halving of supply next year. Every 4 years or so, they halve the amount of output in the amount of Bitcoin. And if you see that, you also see an ETF launch bringing in more retail investors, making it easier for people to invest. Bitcoin really should be garnering some momentum going into next year, but it just isn't. And I think part of the reason is that we are seeing higher real interest rates, right? We are seeing interest rates pushing higher, and therefore, you know, people probably don't have as much speculative money lying around. Yet, other speculative assets, like, you know, your bids on NVIDIA and so on, are really doing well. So maybe it's a case of not so much that, you know, that people don't have the money, but perhaps a little bit more that the AI story has taken the shine off of cryptocurrencies. I think AI is the new shiny thing, and that's where investor money is going.
That's an interesting take. I hadn't thought about that, but that probably makes a lot of sense. All right, Eddie, I want to just go to China here. How concerned are you? How concerned should the global economy be about just, it seems like day after day, you know, kind of disappointing economic data coming out of China, weakening data coming out of China. How do you put that in perspective?
But wait, I thought they were finally giving a stimulus with
now,
a new
now we got some stimulus coming in.
Triple R cut. They're giving money to parents of kids and kids of parents.
Yep. Yeah, and look, it's been this machine gun of stimulus, literally. You know, day after day, you're coming in and you're hearing more and more stimulus coming towards the Chinese economy. And yet, today, the moment we got in a little bit of bad data, we got that PMI numbers showing that the services sector is slowing down, which you would think would be something that would lead to further stimulus in China. what do we see? We see the market actually reacting, you know, to the downside and saying, well, this is bad news and China is every bit as bad. Now, you ask how does it play for the world economy? It's bad for the world economy. It says something bad about the world economy. It says that we are not buying Chinese stuff and we're not exporting it elsewhere. But it is very bad for Europe, right? Because it's you know, and I think that's why we saw Mercedes-Benz perhaps, reacting to the downside today, even though they've got this fairly positive story vis-a-vis Tesla. And the reason is that a lot of their cars go to China, a lot of the high-end equipment that's manufactured in Germany, and a lot of the French luxury goods go to China. So if they are not spending, if their services sector slows down, that's real trouble for Europe.
I will say Ola Hellenius is now a little bit more, he's not as bullish on China as he once was.
Who is that?
We have a great story, the CEO of Mercedes-Benz on the terminal, even though they have, a concept car that has long range.
Any takeaways? I mean,
my takeaway is that GM already has that kind of range. You know, the Cadillac Escalade IQ or the Silverado EV, they already have 450 miles of range. It's great to see it in a smaller package, and I think it's cool that Mercedes is doing it, but they're not as bullish on China as they once were. Also, the PMI data on China, this is backwards. If they come out on Sunday or Monday and say, hey, we're going to give money to everybody with kids under 3 and everybody with parents over 3, and we're going to cut the foreign reserve requirements at banks from 6% to 4%. So that's all stimulative going forward. Why do we care so much about the backward-looking data release?
Yeah, absolutely. So the PMI number being focused on the services sector, which is more important for the Chinese economy than the manufacturing is, because they want to pivot away a little bit towards the services sector, right? So I think as long as we, that should be a net positive, because it should mean that they are more likely to deliver even more stimulus if more is needed down the road, right? It shows that this hurts the part of the part of the economy that they're most concerned about is under pressure, and as long as that's the case, stimulus will keep coming. But I think
drop the machine gun, Eddie, and grab a bazooka.
Right, absolutely. But this, and you know what? If they did bring the bazooka, if they did say, hey, here's this massive stimulus package, all of these things that we've talked about over the last few weeks, and they delivered all of that in one day, the markets would have said, wow, shock and awe, and would have responded accordingly. But because it's a kind of drip feed, it just doesn't have that momentous feel to it. But I do think that this is more about what we're seeing today is more about reading what the market sentiment on China is than about what the outlook is. Because I don't think the outlook has changed today. What you're saying is true, right? The PMI data is slightly more backward looking than the fresh stimulus. But we are seeing something about the market wants to be negative because the market doesn't buy the China story at the moment.
Well, I mean, one of the things that I think we're trying to get a grip of is how bad is the real estate issue and the financing of the real estate economy in China. How bad is it? How bad could it get?
Yeah, and it is really bad, right? And I think most of the stimulus has been targeted at that sector. Now, we had Country Garden, which is one of their big property developers, was very much distressed and still owes something like $187 billion worth of outstanding bonds. Now, they met payment on part 2 of their outstanding bonds today, but still, several billion coming due in the next few months. And it's unclear whether they'll be able to meet most or any of that. The market currently pricing their bonds at something like, 9 cents to the dollar or 14 cents to the dollar, depending. The authorities have targeted a lot of stimulus at that sector. What is interesting that they've done of late is that they pivoted also to things like the stock market, right? So clearly stimulating the stock market by removing some of the costs and some of the taxes associated with that. And if you're seeing the authorities really targeting the stock market, it tells you something about what they want to do to sentiment. It tells you something that they, when they're targeting the building sector, that tells you something about what they want to do to the economy. When they're targeting the stock market, it tells you that they're really worried about sentiment too.
Yep. Hey, Eddie, everybody I know, it seems like, with a notable exception to John Tucker, vacationed in Europe this summer. What's the economy like in Europe these days?
Yeah, it's mixed, right? I mean, Europe is slowing down, no doubt. Europe is struggling at the moment. We're seeing our manufacturing, deep below 50 on the PMIs. And we're seeing now, with the latest revisions that we got in today, numbers in Europe have all been below 50. Europe has really been struggling, and it just hasn't been able to gain that traction. Now, the situation in Europe is a little bit different from the US, whereas the Fed has a dual mandate: growth and inflation. In Europe, the central banks are supposed to be, the ECB is supposed to be focused 100% on inflation.
Yep.
And that means that they're probably putting more pressure on the economy than they would have otherwise. Now, whether they will keep that line, if they coming to see real trouble, real structural trouble in the Eurozone, none of that we're seeing yet. But if that's the case, I think the ECB will start to rethink their policy.
Despite inflation.
Right. I don't know. I mean, all those U.S. vacation dollars being spent in the UK.
Well, hotel prices are very
Crazy.
high. Restaurants have been able to get a high ticket price.
Yep.
But
All right. I stayed on the Jersey Shore. It did just fine. Eddie Vanderwalt, Deputy Managing Editor of Markets Live team of Bloomberg News. Thanks so much. Right now, let's head down to Washington, D.C. Amy Marsh has got world and national news.
Thank you, Paul. Congress returns to Capitol Hill today after its summer recess. There's plenty on their plate, including, as you guys were talking about earlier, a possible government shutdown in just a few weeks. Paul Helmke is a professor of practice at the O'Neill School of Public and Environmental Affairs. He's also the founding director of the Civic Leaders Living Learning Center at Indiana University.
In order to avoid a government shutdown, we need to have our elected representatives start thinking about the common good and majority rule and the importance of the budget rather than fighting out their fringe partisan agendas.
Professor Helmke says current partisan rancor in Washington makes it highly unlikely that they'll have a continuing resolution, much less a full budget. President Biden says he doesn't think there's going to be an auto workers strike at any of the big three Detroit automakers. He made that comment yesterday during an event in Philadelphia. However, the United Auto Workers president, Sean Fain, at a Labor Day parade in the Motor City, said President Biden must know something that they don't know.
We're not asking to be millionaires. We're just asking for our fair share.
Negotiators for the auto industry have said that contract talks could be extended past the September 14th deadline if both sides agree. China may never eclipse the U.S. as the world's biggest economy. The Bloomberg Economics forecast shows China's GDP may briefly surpass that of America in 2040, but even then it'll happen by only a small margin before falling behind again. Bloomberg's China credit editor Kevin Kingsbury says the economic narrative has shifted surprisingly quickly.
China is now struggling to even get to 5%. If it doesn't get to 5% this year, this would be the third year in a row that it hasn't reached that economic growth level, something that hasn't happened since Mao's death back in the 1970s.
They see China's economy slowing to 3.5% in 2030. Global news 24 hours a day, powered by more than 2,700 journalists. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. This on a day when the major stock averages, they are all lower, the dollar higher, oil also higher, and oil prices, in fact, in the driver's seat, it looks like right now for the markets. As the Saudis extend their production cuts, Brent, that topped $90 a barrel, coming back down just a bit, up 65 cents right now, 89.65 on that benchmark price. Energy, the best performing industry group in the S&P 500 as a result of that. Meantime, you just heard from Lori Calvasina at RBC Capital Markets in New York. She's among those that think the recession can be averted in the U.S.
It feels to me, and this is something we were saying early last year, that this really smells more like 2015, 2016, where the economic damage may not quite end up being a recession, maybe something, sort of a cousin to a recession.
The S&P 500, 16 points lower. That's down 0.4%. 44.99 on the index. The Dow Jones Industrial Average, 94 points lower. The NASDAQ 100 down 19 points. That's down 0.1%. 2-year yield, 4 basis points higher. That's at 4.92. The 10-year is up 6 basis points. That's at 4.24. And then the news from ARM, they're going to offer 95.5 million ADRs. The price range $47 to $51 each. Significantly smaller initial public offering than the phone chip designer had previously targeted. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker studio. We are streaming live as well on YouTube, so just head over to youtube.com and search Bloomberg Radio. Let's get a look at these markets. I mean, you come back from your little vacation in the summer. You look at the S&P; it's up 17.2%. Maybe you just go back to the beach. I mean, maybe that's not a bad year right there, right? I mean, but I think professional managers have to put money to work. I don't think they can really do that. Let's check in with Ted Oakley. He does this stuff. He's a founder and managing partner at Oxbow Advisors. Ted, if I were in your business, I might just go into all cash and take my 17% and go home. What do you guys do when I do this stuff for a living?
Well, that's interesting you say that, because we do have a lot of cash like that, because from here on out, the rest of the year, you can earn 5.5 just on the 90-day treasury. So, you've got to keep that in mind. I know we have a lot of cash, a lot of treasuries right now.
So again, if you got a lot of treasuries, what's the impetus to get that money kind of off the sidelines, if you will, to go into make a play into equities or into fixed income? Kind of what are you looking for?
Or get more bearish, right? I mean, everybody and their brother is in the soft landing camp now. It's like super consensus, even though we've had the Fed raising rates 550 basis points in 14 months.
Well, you can't count us in the soft landing group, I have to tell you. I really think people forget that recessions are caused by slowing demand. You can talk about all this other stuff, but if you look at demand in every area right now, credit card delinquencies are up, car payment delinquencies are up. You're looking at luxury good sales are down. Walmart, look at everybody that's announcing right now. Macy's, their business is down, and people are pulling back. You're looking at job openings going down. And then you still have this super inverted yield curve. And so I'm not certain people realize that we're in a cycle. It takes a long time. This is a big battleship. And so you can't just say, hey, it's going to be a soft landing. I think a lot of people call for a soft landing probably haven't been through, a 2003 when you didn't have a real big recession, but the market was overpriced, just like it is now. I mean, we're 21 times forward earnings. You don't start a new bull market usually from that level.
Ted, some of the bulls out there would say, okay, you 21 times earnings, but you pull out some of the big cap, those 5, 6, 7 names that have really propelled the market this year. Then you're down to a more reasonable multiple. I mean, how does that kind of analysis ring for you?
Well, I understand what you're saying. I would say this, though. If you want to go the other direction and go toward the CAPE ratio, it's even worse. It's like
what ratio?
32 or something. Okay, the strictly adjusted PE ratio.
Oh,
if you adjust it for inflation. If you see the CAPE, if you look at that, it's like 31, 32 times. I mean, what I think people forget is they want this so badly, the Fed to come back in, lower rates, and go back like we were for like 12 years or so. And it just doesn't look like we're going back to that. I can see rates coming down a lot, but I think it would be because we have weakness in the economy.
So never ever again, Paul.
What's that?
Never ever again do we get back to ZIRP.
ZIRP.
Zero interest rate policy.
Oh, no, probably not.
Or NERP.
But it doesn't matter because you're locked in for 30 years on your
That's right.
2 and 3/4. So, Ted, so I take it that you're kind of still thinking of a recession and maybe a meaningful recession. Is that still in the cards for you?
It is. I think it's a slow go. I mean, I think people don't realize these things take time to transpire. And the worse you beat up the consumer, really, and I know they want to say the consumer's okay. The consumer's not okay. They're borrowed up the hill. Credit card interest rates are 22.25. I mean, you're in a situation right now where the consumer's in a squeeze right now. And if you you go out and talk to people in the business world, and they'll tell you that business is not as good as it was last year, just in general, or the year before. And so I think that's what people are failing to miss here. They keep trying to pull this recession in from another category. Recession starts with demand, and GDP starts with demand. So if you don't have it, and then it's not coming from the government. Our deficits this year right now are 2 times what they were last year. Same thing, and there's a reason for it. They don't have any tax receipts. Interest rates are high. They won't be able to come to the rescue either, in our opinion. They may eventually, but not right now.
Ted, you're based in Texas, right?
Austin, Texas.
Austin, Texas. WTI crude oil, $87 a barrel. You guys don't care about anything else, do you? Life is good in Texas.
Well, you would say that, but there's so many parts of the state of Texas that don't really depend on oil. Now, we own oil, obviously. We own the gas pipelines. We own a lot of things in oil, but that's just a part of a portfolio. But in certain parts, yes, it helps to have it that high. It certainly helps with cash flow for these companies when you can, instead of being 65, it's 85. That always helps. But we haven't had as much exploration as you might expect, or an increase in exploration because of the higher price yet. That doesn't mean you won't get it, but we don't have it yet.
All right. Interesting stuff in terms of oil that we're watching today, right? Because the cuts are going to stay in Russia, and the Saudis have agreed that they'll keep them until the end of the year. But it is really all about demand on that side as well. And I just don't see it rising much more than it is now, right?
It's hard to say. Oil is one of those things that it really it befuddles a lot of people, including me, by the way. So I don't know. I mean, one of the things right now, it's pretty tight supply demand, and they've taken this strategic reserve and they've emptied that out. If they were to start filling that back up, which they should, but that creates another piece of demand, and all of that was really unfortunate because that hurt the whole system. But
Ted, when you want to buy votes, you got to buy votes,
Well, that's true. The other side of it is that usually oil in the latter stages sometimes, and it's interesting, in 1977, I pulled a graph of this last week, I put it on Bloomberg, and I looked at 1977 stock market was down all year long. Oil ended up higher.
Right.
So it doesn't necessarily always go with the market. You never know exactly how it's going to go, but that's what you see from time to time.
All right, Ted, thanks so much for joining us again. Always appreciate getting your perspective. Ted Oakley, he's the founder and managing partner of Oxbow Advisors. And again, calling out crude oil here. Brent crude had touched $90 a barrel a little bit earlier this morning, just below $90 a barrel here. And OPEC are extending their cuts for another 3 months. Russia, the same. So seeing that supply side of that supply-demand situation kind of move forward, higher prices. The concern had been, prior to that, where's the demand? If China is not as strong as initially thought or initially anticipated at the beginning of the year, maybe that's a little bit bearish for crude oil, but we're seeing big moves up this year in the crude oil. We'll keep an eye on that. More coming up. This is Bloomberg. Let's get some company news with Lisa Mateo.
Well, ARM Holdings is planning to raise as much as $4.87 billion in what would be the biggest IPO of 2023. Bloomberg's Ed Ludlow said ARM has previously hoped to raise more than that.
We believe that ARM wanted to raise between $8 and $10 billion at a much higher valuation, say $60 to $70 billion. But what happened or transpired was SoftBank acquired the 25% stake of ARM that the Vision Fund held. And we know that all told after the transaction, SoftBank will still control 90% of the shares.
Now, in other news, the United Auto Workers Union and Detroit's Big Three automakers are still struggling to reach a new contract. In Philadelphia yesterday, President Biden says he's not worried about a strike, but not everyone agrees. Bloomberg's Erica Hershkowitz explains.
United Auto Workers President Shawn Fain says Biden must know something they don't. Fain said the union stands ready to strike unless the automakers meet demands in ongoing contract negotiations. The union's looking for better terms with Ford, GM, and Stellantis. The current contract expires on September 14th.
Checking with shares of General Motors right now, down about 1%. Ford Motors down a fraction. Stellantis down about 0.8%. And Southwest Airlines and the International Brotherhood of Teamsters have reached a tentative agreement for the airline's materials specialists. Southwest says the nearly 500 workers support the airline's technical operations by having the right tools and parts in place to maintain the aircrafts. Shares of Southwest right now down about 0.2%. Those are the company stories we're following this hour. We'll have much more Bloomberg Markets in just a bit. I'm Lisa Mateo, and this is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, looking at these markets here, the S&P 500 off about 0.25%. The Nasdaq's off about 0.1%. Yields are higher, 4.25% is your 10-year. We're keeping an eye on energy. WTI crude oil up 1.3% today, $86.67 a barrel for the West Texas Intermediate crude. Keeping an eye on that. Bitcoin, it's off 0.5%. We're now below $26,000 per token. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Mars.
All right, thank you, Paul. Lawmakers are returning to Capitol Hill in Washington, D.C. today after the summer recess. There are a number of issues on the agenda, including a potential government shutdown in the coming weeks. Paul Helmke is a professor of practice at the O'Neill School of Public and Environmental Affairs and the founding director of the Civic Leaders Living Learning Center at Indiana University.
This year, it looks like they're going to have trouble not only doing a new budget, but also adopting a continuing resolution that could have some serious impacts for individuals as well as the nation's economy.
Other issues facing Congress include Senate Minority Leader Mitch McConnell's health situation, which he could address this week. President Biden put his record on the economy up against former President Trump's in a Labor Day pitch to union workers in Philadelphia. Wendy Schiller of Brown University's Taubman Center for American Politics and Policy says unions don't really vote in a monolith.
It depends on the sort of local balance on where the jobs are, but public sector is still in the 30s in terms of unionization, and that can really matter in some of these key swing states. When Republicans go after unions, go after labor, they go after public employee unions, that can cost them votes.
Wendy Schiller of Brown University was a guest on Bloomberg Surveillance. You can hear more of her thoughts on the 2024 race on the Bloomberg Surveillance podcast. First Lady Jill Biden has tested positive for COVID-19. Her office confirmed that news, saying the 72-year-old is experiencing mild symptoms. She is expected to remain at home in Delaware. Meanwhile, the White House says President Biden tested negative for the virus last night and that he will test at a regular cadence throughout this week and monitor for symptoms. The president is scheduled to leave the U.S. on Thursday for a trip to India and Vietnam. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Matt and Paul.
All right, Amy Morris, thank you so much. We appreciate it. So, Matt, they had an auto show in Munich last week. I was surprised you weren't there.
Yeah, no, I was on the Med.
Oh, okay.
In Spain.
Nice.
But I did obviously read all the coverage about the show. It seems a lot of the producers, the manufacturers who went there didn't bring too much product. There were a couple of concept cars that we talked about. We've already spoken about the new Mercedes CLA concept, which is reportedly going to have 466 miles of range. And there was a new BMW concept that was along similar lines. It's an EV. It's like the future of the I guess iconic 3-class.
Are they even launching new internal combustion engine cars anymore?
Yes, but usually they are revamped, rejiggered versions of old ones.
Okay.
Although Stellantis has a new engine out. It's an inline 6. They call it the Hurricane, and it is amazing. Amazing. But yeah, for the most part, EVs is what we're looking for, and there just aren't very many new ones out now. So most of the ones that we're seeing are going to be available for purchase in 2025.
Okay.
Which isn't really that long away if you think about it.
No, and I mean, I guess they're not worried about, Tesla running away with things because Tesla
doesn't bring out new cars.
Right, they don't bring out new cars. So
they just had a new version of the Model 3, but it's just a facelift. So look, John Tucker's falling asleep as I talk about it,
He's not an EV guy.
It's just like...
Not an EV guy yet, but he's going to
have to be an EV guy.
Yeah.
Well, how do they, just for me, for acceleration, torque, how does the EV stack up?
So, like worlds better than whatever you're driving right now.
So why aren't you completely sold on EVs and still stick with your naturally aspirated whatever?
Because I just don't get the same kind of feeling. It doesn't have soul for me. I don't have the smells, the vibrations, the sounds, but I'm old, right?
Exactly.
For young people, like
that's
like
the future.
Jess
like
mentioned,
Jess mentioned,
that's EVs are the future.
That's the future. All right, we're gonna have more car talk coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with Allison Williams. She's a senior analyst covering all the banks for Bloomberg Intelligence. We're going to get the latest on what we're seeing out there in the global banking space. We'll even check on UBS. Have they closed on that Credit Suisse deal? I'm not even sure. Billy Lipschultz, he's going to join us. He's a markets reporter. This ARM IPO, I've got a lot of questions about this ARM IPO. I would go in with a lot of reservations, but that's just me. But we'll see what Bailey has. He covers all the IPOs for us. Eric Lynch, managing director at Scharf Investments, will join us as well, give us his market call here as we all come back to work in September. Always at work, John Tucker with the Bloomberg Business Flash.
All right, Paul, Matt, S&P 500 right now hovering just around 4,500. Treasury yields marching higher. The dollar, that's around the highest it's been since the spring. As you mentioned, Brent crude, that rallied. It was over 90. Well, right now, just a little shy of that, 89.91 for the international benchmark. This comes as the key OPEC plus producers extend their supply cuts into the end of the year. Now, as the Federal Reserve considers pausing its cycle of rate hikes, Catherine Kaminsky at Alpha Simplex Group says investors may be getting ahead of themselves.
Everyone's really ready for there to be a pause, and there's probably a pause, but I think it's going to take a while before we see a flatter yield curve and before we see a situation where inflation has come down. Thus, we're going to see higher yields for a little bit longer.
Fed Governor Chris Waller says there is nothing that is saying we need to do anything imminent anytime soon. And as we start the trading week, keep in mind seasonal trends place September in last place for stock market performance, Jess. And I'll throw this out to you, car guy. National average for a regular gasoline now stands at $3.81 a gallon, so that tops this time last year. Your individual prices may vary depending on your 1020.
I think there's a huge variance, by the way, because I see almost $1 difference between the cheapest gas stations and the most expensive ones just around me, just within like a 1 mile radius in Scarsdale.
I mean, I see a refinery from my house, so
we live in different places, John Tucker.
We have John Tucker and I. We grew up with petrochemical plants, refineries, all that good stuff right in our backyard.
Explains a lot.
So you know we're just fine. We're kind of immune to all these other external things. John Tucker, thank you so much. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. While my Dukies were beating up the Clemson Tigers, the Texas A&M Aggies were some cupcakes. Who did you play against? Our little sisters
New
of
Mexico.
the poor. Oh, New Mexico. Okay.
Yes.
And you guys
Miami's
managed
this
to win?
next weekend. Oh, we did.
Okay.
By a lot.
Okay. Very good.
It was quite
All right,
the game there.
Let's talk about these markets. What do you got for us? Kind of red and green on the screen
I
here.
had the pleasure of filling in for you both last week with, of course, John Tucker was here with me on Friday. It was a fun one. It was a fun one on Friday.
That is radio gold right there.
Oh, it was. You thought it'd be a slower day on Friday, but they kept us busy, so that was a good one.
Good.
When it comes to the markets, something I'm keeping a close eye on is actually where the dollar is headed this month. So if you're looking specifically at the DXY, it's actually trading around 104 right now. More from a technical perspective, 103 was kind of a key threshold in recent months because it eclipsed that last month. It came down in recent sessions, especially as we saw more support in the broader stock market that was coming down lower. Obviously, that correlation too when you're thinking about yields as well, but that's something that a lot of my sources are keeping a close eye on this month. Yes.
You know what I look at, thanks to Abigail Doolittle, our buddy in Bloomberg, is the RSI function.
Correct.
Yeah, and boy, the DXY index is right smack up against
so
that high
we
average.
actually saw it oversold back in mid-July, so you can see that in the chart when you are looking at the RSI. And then once we got toward like maybe around August 25th, that was actually around Jackson Hole and when Fed Chair Jerome Powell was speaking, that's when it was right under that 70 level, which would have been overbought territory. So we saw it come back a little bit, but now it's pressing up against that 70 level once again. So that's something that, in addition to yields, when it comes to the dollar and the direction of the dollar, especially in the next few weeks ahead of the September 20th decision for the Federal Reserve, that a lot of my sources are keeping a close eye on.
Does the RSI really matter?
Oh,
I mean,
yeah.
the relative
I
strength
know
index.
I knew that was coming.
It's
I knew
kind
it
of
was coming.
the BSI, really, isn't it? Because it doesn't. I mean, it doesn't ever seem to really push.
But
in either
you
direction.
can look at the RSI
anything.
on not just the dollar, but you can look at that on a lot of different levels. Whether
I
you're
do.
looking at an
Put it up
index
for what?
level for the S&P,
It just
NASDAQ
hits
100.
the bottom, hits the top, and bounces. And
Right.
I think
So
it's the best thing ever created. Thank you, Abigail.
But Matt, of course, I knew it was going to trigger him a little bit, so that's why
Of course,
I was like,
I'm also
going
a
to bring it
VIX
up.
guy, and
Yeah,
he's
oh,
not
and
a
then-
VIX person. You know.
It's great, though. It builds for great conversation between
Exactly.
the two of you. Other names when it comes to individual movers, I'm keeping a close eye on. So I was still here on Friday, even after the bell, but taking a look at what
Really?
S&P Dow Jones indices were announcing as far as what's happening in the next few weeks with their quarterly rebalance. So Blackstone, if you look at that stock, ticker symbol BX, as well as Airbnb, that's ticker symbol ABNB. If you look at Airbnb shares, it's actually up about 8%, Blackstone up close to about 3%. So this did come as S&P Dow Jones indices did say that both of those would be entering the index before the opening of trading on September 18th, and so they would be replacing Lincoln National as well as Newell Brands prior to the start of that trading. And you look at both of those stocks up pre-market, or actually in morning trading.
All right, interesting. Anything else we're looking at here? I'm just looking at New York City set for longest run of 90-degree days just as summer ends. That's what I was reading as you were going through your thing.
I mean,
so now we're
everyone
getting
keeps saying
summer.
summer's over, but let's not do that, right?
No.
I feel like technically we still have a couple more weeks until it officially ends.
Well, I think that September for John Tucker and I is the best time of the year.
I love September.
Yeah.
It's the best month in New York, I feel.
Well, it's, all the folks from places other than New Jersey stop coming because it's the end of summer
So that's
for
why,
them.
you
So
can
we get a
enjoy the
break.
Sweeney compound with
There's no
with the beach.
traffic. It's still warm. The water's gorgeous. So.
Well, there you go.
And there is the beach today.
Oh, that's-
There's nobody
I'm sure
on
you're
there.
regretting being here with us,
Nobody
Paul.
on there. So anyway.
Beach cam.
All right, so what else are we looking at? Anything else, or are we just going to wait for it? Because there's no earnings for a while. It's just, the Fed coming up at the end of the month. I mean, it's really, as I look out there for catalysts, I don't really see anything.
John and Tom on Surveillance talking a lot about the ECB, which is an acronym that stands for the European Central Bank.
Yes.
Does anyone care?
The decision
Why
coming
do we
up.
talk about the ECB?
Actually, we have the
Because-
Bank of Canada has a decision tomorrow, and then on the 14th.
Is that more or less
is-
important than the ECB?
And I would say people are probably more focused on, obviously, the ECB next week on the 14th. Actually, this is the last week of Fed speakers before next week is the blackout week. So
Thank goodness.
that's why you were hearing from Chris Waller earlier this morning, and then you'll have a bunch of others. Actually, Jim Bullard, who obviously is not at the Federal Reserve anymore, but he is on the calendar to speak tomorrow.
Well, Surveillance, they give them credit. I mean, they're on at like, at 5 in the morning,
They-
6 in the
they
morning.
are.
So they have a big European audience there, Matt. So they're speaking to the UK and the European
But
audience.
we do still have other names.
True.
So Zscaler will be reporting earnings today. There's also American Eagle later this week, DocuSign. Actually, Kroger is on Friday. They're the ones that had about 8 mentions of AI in their last report compared to when they
30.
normally don't. I did want to point out, though, FedEx actually reports the same day as the Fed decision on the 20th. They're actually after the closing bell. They're off calendar, but typically that is obviously a
Now,
bellwether
Pretty Gupta
name.
was all over.
Yeah.
with FedEx.
She
but
loves
now
the
she's in
FedEx.
London, so
Right.
I mean, I'm not sure we're going to get the same coverage.
She'll cover DHL more.
DHL more.
Yeah.
She's into
Yeah,
that.
that's
okay.
right.
Because that's based in Germany, right? DHL.
Yes,
Deutsche,
it is. Deutsche Post.
But
All right,
yeah,
Deutsche
so I'm looking
Post.
ahead to FedEx on the 20th.
And Texas A&M, who do they play this weekend?
Miami.
Where?
The U?
The U.
Or of Ohio?
Yeah, you.
Okay.
Yeah.
And is that going to be in Miami?
No, sorry.
Is that Miami or College
Actually,
Station?
double check if
All right,
it's.
we'll
I'm thinking it's in Miami.
Okay, it's going to be big.
That's a big game.
Miami, Texas A&M. All right, good stuff. Jess Menton, thanks so much for joining us. Jess Menton, she covers all the equity markets for us. Let's go to Allison Williams, our good buddy at Bloomberg Intelligence. She follows all the big banks. Allison, is my former employer Credit Suisse, are they still in existence, or has UBS put the kibosh on that? Is that closed yet?
Closed, and I think, last week we sort of had the first look of what the combined entity will look like. As you can imagine, once there's an announced deal, obviously the trading with Credit Suisse, you would expect it to really fall off, and we did see that. So when we look at the and it was interesting because UBS did report sort of every flavor. So they reported sort of their new numbers, their standalone numbers, Credit Suisse standalone numbers. And when all is said and done, it looks like UBS on a pro forma basis basically kept in line equities trading, FICC trading, also with regard to the fee business, sort of kept in line with peers. Credit Suisse standalone, as I said, the trading obviously goes away. The M&A front is really the one thing that we've been looking at, because when UBS made this deal, the global banking and research areas were areas that they talked about they wanted to capitalize on related to Credit Suisse. And so the M&A business, as well as some of the tech IPO expertise. And so tech, as you know, there haven't been many tech IPOs, but actually Credit Suisse sort of did hold its own, despite, again, the merger. So it's a little bit different than trading, where the bankers do have those relationships, and sort of the deal got booked under Credit Suisse. Obviously, IPOs are down a lot, and it looks like it continues to be a weak spot. We'll see what happens in September.
What about this talk of trying to get assets back that left Credit Suisse in the months before the forced merger? I think $200 billion is the number that's been thrown around. Where did those assets go? And what's the likelihood that a substantial portion come back to UBS?
So I would say that one of the most positive things that we saw in the quarter was the stabilization at Credit Suisse. So that is the first step. And so, the competitors were certainly circling. There were so many comments about the business that was going to be taken away after the deal. And it seems like a lot of that damage was already done. And in fact, we saw deposits, I think it was about 18 billion of deposits coming back to Credit Suisse in the quarter, and then another 14 billion or so. So I might be mixing those numbers up, but within that 10 to 20 billion, second quarter and third quarter to date through August 28th, Credit Suisse bringing in those deposits, and actually UBS flat. Also on the wealth flows front, which is I think that sort of was the key area, and was an area where the volatility really kind of forced this deal. They're also seeing inflows that turned positive in June, and they've seen inflows so far this quarter for Credit Suisse standalone, and then UBS really holding its own on that business. So I think, will they recover the full amount lost? No, I wouldn't think so. There is a lot of client overlap between these two banks, and so there will be some client diversification, but I think that the positive sign is the stabilization and the potential that, a lot of the damage may have already been done.
All right, Allison, from, my history on Wall Street, investment banking, capital markets, is UBS pro forma for this merger with Credit Suisse? Are they going to be able to be more competitive with the Goldmans and the Morgan Stanleys and the JP Morgans of the world, or are they not even going to make that fight?
I mean, I think, it's tough to tell, because